Good morning. Welcome to the November 14th, 2022 meeting of the Economic Forum. We're going to start with our agenda item 1, which is a roll call.
Mr. Crum,
I'm here.
Mr. Levitt,
Here.
Mr. Zahn,
Present.
Vice Chair Lewis,
Here.
Chair Rosenthal.
Here. Thank you. For the second agenda item, I'd like to make some opening remarks. So good morning. For the record, I am Linda Rosenthal, Chair of the Economic Forum. I would like to welcome the members, presenters, staff, and members of the public to our November 14th, 2022 meeting of the Economic Forum. I would also like to thank the Legislative Council Bureau's staff for their assistance in setting this meeting up and their work today to allow this meeting's agenda to be completed. It is wonderful to have all the forum members and so many other meeting participants together in person this morning. The Economic Forum is required to provide a forecast of unrestricted general fund revenue for the current fiscal year, FY 2023, and FY 2024 and FY 2025 of the next biennium on or before December 3rd, 2022. When the third falls on a weekend, the forum is allowed to meet up to 2 business days following that weekend, and therefore we will be meeting to provide the required forecast on December 5th, 2022. At today's meeting, we will have preliminary forecasts presented by the various forecasters for FY 2023, FY 2024, and FY 2025 on the state's major general fund revenue sources, and the Technical Advisory Committee's preliminary forecast on the minor revenue sources approved at their meeting on November 4th. As has been historically done at the November meetings, the Economic Forum will not be formally approving any preliminary forecasts for any of the state's general fund revenue sources or tax credit programs at today's meeting. This meeting is intended to allow the forecasters to present their preliminary forecast and their assumptions or outlook used in generating the forecast. It is a chance for the members to ask questions and obtain information in preparation for the December 5th meeting, where the forum will approve forecasts used by the governor in developing the executive budget submitted to the legislature for the 2023 regular session. For today's meeting, we will have a presentation by Emily Mandel from Moody's Analytics on their current economic outlook, as well as their forecast for the sales and gaming taxes. After that, we will proceed through the agenda items regarding forecasts for the major and minor revenue sources. With that, I would like to ask whether any of the other members have opening remarks they would like to make. Nope. If not, then I would like to proceed with any public comment under agenda item 3. I will also ask Mr. Ginden, as staff to the forum, to assist me as needed in conducting today's agenda. Is there anybody here in Carson City who would like to make a public comment? Okay. How about down in Las Vegas? Anybody from the Las Vegas location who would like to make public comment? Great. Then lastly, I would ask the BPS staff if anyone has called in to provide public comment and assist in facilitating that public comment.
Chair, the public line is open and working, and we have no callers.
Thank you very much. Okay. Moving on to agenda item 4, we're going to have the presentation on the national, regional, and state economic outlook by Emily Mandel, from economist with Moody's Analytics. Welcome.
For the record, I'm Emily Mandel with Moody's Analytics, an economist. So thank you for having me here today. I'm here to talk about a few things. First off, I want to walk through our assumptions surrounding the outlook for the United States economy, as well as some of the risks that are confronting the economy right now. After that, I'm going to transition to talk a little bit about the Nevada outlook, Nevada performance of the Nevada economy, and then finally I will talk about the forecasts we've put together for two different revenue series. So before we get into all of that, though, I need to keep the lawyers happy. So I like to reiterate that I work for Moody's Analytics, which is a technically separate company from Moody's Investor Service, the ratings agency. So nothing I say today should be construed as having any bearing on any ratings actions, past, present, or future. Okay. So now that we have that out of the way, so there's no doubt that the recovery from the most recent pandemic, the pandemic-induced recession, has been extremely strong. And it's been stronger than we anticipated at the start. A lot of that's coming from the huge amount of stimulus that's been pumped into the economy. But put that together, and we've had a couple of years of very strong economic growth. That strong growth is starting to come to a bit of a close. It's starting to feel a little bit slower. But we are clearly not in a recession yet, and I'd like to reiterate that now that we've had so much talk about recession, about, a quarter ago we'd had that, 2 quarters of negative GDP growth, which set those alarm bells ringing. But I think it's pretty clear, based on the strength that we've seen in the labor market and the strength that we've seen in consumer spending, that we still have a good amount of firepower, we still have a good amount of strength left in the labor market. Okay. So to look at what this chart is showing is we have real gross GDP here in the blue. The blue line here is our baseline outlook. And under our baseline outlook, we assume that the economy does not enter a recession. There are a lot of pressures going on in the economy, particularly as the Federal Reserve raises interest rates in order to bring down some of the inflation we've been dealing with. But our baseline outlook, and the one that I'll present here, is that we managed to walk that, granted fairly narrow path, and avoid entering a recession. That said, however, things are going to feel a bit like a recession, even without, technically entering that sustained and widespread contraction that we would use to describe a recession. And that's really coming off of these 2 years of extremely strong growth. Things are going to be slower, and you can see that in this chart here. Basically, starting where those two scenario bars diverge is things have dipped a little bit, and we expect them to not get anywhere close to what we were over the last 2 years. But I'd also like to put that in perspective of prior recessions, and those are delineated here with the gray recession bars. And so we're not seeing that we would enter a scenario like this. That said, there are a lot of risks right now, definitely more heightened risk than normal. Recession risk is higher than what we've seen probably for many years now. I don't know that any of us exactly saw the pandemic coming and driving a recession right then. And so with that in mind, there are a couple other paths that we could take. And we have those in yellow here as a moderate recession. You can see that moderate recession scenario still doesn't come anywhere close to what we saw back in the Great Recession back in 2008, for example. And there's some good reasons for that based on some of the underlying strength in the economy, some of the tighter lending standards we've had, just stronger strength and balances coming into that. I can talk more about that later. And then potentially more concerning here would be the red line here, which is a stagflation scenario. So stagflation would mean a prolonged period with high inflation and slow economic growth. And so that's one we definitely want to avoid. That's one we think we will avoid, but it's one I'm going to touch on a bit later. So I wanted to lay those 3 paths out here to start with. So what is going to keep us on that blue path, right? What is going to make sure that that assumption, that outlook that we have is going to come true? And the main thing here, the most important part here, is that We really need inflation to come under control. And this chart here shows inflation historically, where we are up until today, and it breaks it out by some of the major categories that we're watching, some of those main areas that we are keeping an eye on in order to get a sense of whether we are moving in that correct path. I think the inflation report that just came out last week was definitely a positive one. Yes, inflation's high, but it's moving in the direction we need in order to keep on that path, that narrow path I'm going to keep talking about here, but that path that we need to avoid a recession. So the main point that I want to convey here is there's not one huge inflation dragon, is how I like to put it, out there that we need to slay. There isn't one huge source of inflation in the economy. It's coming from a lot of different sources. And those different sources are each going to have their own paths for when they're going to come in, for when they're going to come under control here. Some categories here are more responsive to the Fed, and the Fed raising interest rates than others. And so part of what we need to happen is we need to that there not be another major shock to the economy. But as it is now, we're on that correct path. And the Federal Reserve is much more able to have an impact on prices when they're related to demand, right? When they're related to demand in the economy. What they're not as able to control is inflation that stems from supply. And so that supply disruption could be from supply chains, for example, what we saw during the pandemic when, especially in goods coming out of Asia, were facing really large backlogs. We were seeing huge costs in order to get those products to the United States, to even produce those products. Things like the semiconductor shortage that I'm sure all of you have heard about. Things like that aren't very responsive to inflation because they're driven by these external factors. They're not driven by demand. We've seen some progress here. You can see some of these bars here related to supply chains, that purple bar here, and that's things that are by and large kind of really reliant on global trade. Things like vehicle sales, things like apparel, those are starting to come in as we've seen some of those supply chains issues begin to resolve. The other main one here that I would categorize under supply chains is energy. And this, of course, has been a major driver of inflation recently, not just because of the prices that people are paying for gasoline, that people are paying for heating, but because energy prices, gasoline is a large component of the cost in order to transport goods across the country. And so this is something that's beginning to improve. You can see those red bars becoming closer together recently. But this is also something that's a bit at the mercy of what's going on globally, right? This is something that's at the mercy of what's going on in the conflict in Ukraine, as well as, moves by OPEC in order to kind of constrain supply. So this is something that we think is going to keep improving. We have forecast that energy prices will stay elevated relative to what we've seen in recent years, but begin to come down, definitely not hit that $100 a barrel price of oil that was really problematic for inflation for a while here. And then the other components here, things like shelter. This is one that is going to be a little bit slower to come through, in part because of the ways this is measured. But one of the impacts of higher interest rates is it is already putting a damper on the housing market, right? And as we get some of that pressure coming in on the housing market, that's going to have knock-on effects for rents. That's going to have other impacts in terms of bringing down some of these shelter costs just by destroying some of that demand. By having people say, I'm going to stay in my current place for longer, or, maybe for those, Gen Z people out there, maybe it's not time to go find my own place. Maybe I should just stay with the parents for a bit longer. All of that put together is going to take some pressure off here. So there's definitely wild cards here, mostly coming from that supply side, but a lot of these factors are beginning to come a little bit better, beginning to come down. To put some actual quantifiable numbers to this, we are anticipating that inflation will end around 8%, will average around 8% in 2022. This is calendar year, not fiscal year. Will come down to 4% in 23, and then get back on a more sustainable footing in the mid to low 2% in 2024. So That path will keep inflation high over the coming year relative to what we've had prior to the pandemic, but definitely coming down from the levels that we've seen recently. So how are people dealing with these higher prices? Why is this not causing, in a way, more of a contraction in economic activity than it has already? And I'd argue that a lot of that is coming from the amount of cash that's still out there in the economy. This is, honestly, I think a fairly striking chart in just the way that you can see this climbed. And these are household checkable deposits in currency. Okay, so this is the amount of money that people have in their households have in their bank accounts, and it's pretty much anything that you can write a check off of, right? Any money that's readily available to be spent. And this surged massively at the start of the pandemic, largely because of stimulus measures, and it hasn't really come back in since then. And so there's still a huge amount of money out there. Not all of this will necessarily be spent, but it's a cushion, and it's one of those things that's driving this very strong growth in consumer spending, these strong taxable sales also that we'll talk about a little later, is just this cash that's out there. Now, I think it's also important to look at how this is distributed across the economy. Is this all caught up with our millionaires and billionaires, or is this actually pretty broad spread across the economy? And with a notable exception that I'll talk about in a second, it's pretty widespread. Your middle-of-the-road family has significantly more money in their bank account than they had going into the recession. And that's what I have listed here in these blue bars down below. This shows the current amount, or at least as of the second quarter of this year, amount of these deposits that households have relative to what they had back at the end of 2019, so immediately prior to the pandemic recession. And so you can see that with the notable exception of the lowest quintile, these people, I think the lowest quintile cutoff is somewhere around $28,000 in income. Households have significantly more money on hand than they had before. And so this is providing us with a cushion. This is giving people funds that they're able to spend to compensate for the impact of rising prices on some goods that they can't really avoid. You know, areas like housing, you can't really avoid spending money on your rent. You can't really avoid spending money on putting gas in your car. But because there's so much cash out there, they're able to continue spending in some of the other areas of the economy. This also, though, has kind of the counter effect of this is what the Fed is kind of fighting against in the sense. The Federal Reserve is trying to bring in some of this demand in the economy. And given that there's still all this cash out there, it's been a pretty difficult job. And that's why we've seen some of these really rapid rate increases in order to try to tamp down some of this demand. So even as we've seen households have a lot of money on hand, with the notable exception of lower income households, we have seen some recent reversal in terms of how people are basically spending money, how people are paying for the money they're spending, more or less. What I have shown here is bank card balances, credit card balances. So this is your average credit card that you get from like the Bank of America, for example. And I've got this split out by credit score. But honestly, even across these credit scores, it's pretty much telling the same story. It's telling the story that people are starting to rely more heavily on credit card balances in order to fuel spending. At the start of the pandemic, people by and large, took that federal stimulus money and they used it to pay down these credit card balances, which is why you see this large drop at the beginning of the pandemic. But since then, people are starting to rely on these more heavily. It's starting to go up. And this is something that we are seeing kind of across the income spectrum as well as across these credit card score spectrum. In addition to this, I don't have a chart on this here today, but we're starting to see some increases in default rates for these credit cards. Not just credit cards, but a lot of areas of loans, with the notable exception of housing. Housing, people have stayed on pretty fair terms, but we are starting to see somewhat of an increase in those default rates across other types of lending. Still not high by historical standards, but kind of getting us back to a more normal level there. Because once again, at the start of the pandemic, people got these stimulus payments. They were able to avoid defaulting, pay down these balances. Now, the other part to keep in mind is that financing costs for these balances are a lot higher than they used to be, right? Because interest rates are rising. So the impact of debt is going to be potentially more problematic for some people than before. Okay. So our baseline outlook, kind of like I've been talking about, is that inflation is going to come in. The labor market is still in a strong enough place that even as the Federal Reserve raises interest rates to try to pull back on some of that demand, that's going to manifest in bringing in some job openings, for example, having companies pull back on hiring. By pulling back on hiring, we're going to take some pressure off of wages. And that, in turn, is going to help inflation kind of come under control along with these external factors that I was talking about earlier. Now, there's still a lot that could go wrong. The Federal Reserve historically doesn't have an awesome track record of raising interest rates without spurring a recession. So while we think they're still on that path that'll let us avoid it, there's definitely factors at play that could lead us into one of those lower scenarios that I showed at the beginning. The first and likely, to describe this though, this is a risk matrix. And so these are fairly subjective scores on the left here, and they're kind of a list of different things that could go wrong. There's a lot out there, but that's just because we're at a risky place in the business cycle right now. Ones higher up on this chart are things that we think subjectively are more likely, risks that are more likely to come to pass. And then ones further to the right on this chart are ones that would have a more severe impact. The severity of the shock would be higher. So what we really need to worry about is things on the top right of this. And so I'd like to call your attention to two different ones here. Those are in blue. First one is kind of what we've been talking about. The Federal Reserve is raising rates, but if they overdo that, if they raise rates too quickly, that could lead us into recession by pulling back on that demand too fast, causing businesses to not just remove some of those openings, not just to pull back on hiring and maybe not replace lost positions, but lead to actual layoffs. That would be fodder for a recession. Now, the risk here is that we don't see all of the impacts of higher interest rates immediately. It takes time for that to play out in the economy. And there's different kind of fault lines that this can play out in, one of which I referred to earlier, which is the housing market. Another one is related to just the global economy and the impact that what our policy at home has on the global economy and how that can reduce global economic growth, which then can give us a feedback loop. I'll talk about that a little bit later. But because this is a very kind of difficult path and because not all of the impacts are seen immediately, it's difficult to know in the moment whether they're raising rates to the appropriate degree or whether that over-tightening is going to cause greater instability in credit markets, whether it's going to cause a steeper pullback than we'd like. So that's risk one. Risk two here is related to an external shock. And this is what we were talking about back when we were on that CPI chart. And this is that something could happen, whether it's an energy shock, whether it's the situation with Russia currently, that could cause kind of a supply-driven increase in prices. And this is something, like we've been talking about, the Federal Reserve is not well equipped to confront. And this could put us into a stagflation situation, so a situation where economic growth is slower and inflation gets harder to bring under control. And the end result of that would have to be a steeper recession than we'd even consider under this first potential downside, because the Federal Reserve would need to take much more extreme action in order to kind of reduce those, the feedback loops that would be driving inflation at that point. Okay. So we perhaps are on the optimistic side here. We think that things are going to continue on a decently positive routes, definitely slower, but moving in the right direction. But there's a lot that could go wrong, and I think it's important to keep those potential risks in mind, and to kind of have an idea of what to look out for to see whether we might be shifting onto one of those other trajectories. Do you want to do questions now, or, okay, yeah.
Yeah, for the record, Linda Rosenthal, if you don't mind, I think it'd be nice just to pause before we get into the specific revenue forecast to see if anybody has any questions on your overview. Members?
Yeah, can I? You know, you're well aware, the difficulty we have right now, the way I see it, is that we've got to provide estimates for the next 2.5 years. And we're right at the beginning of something happening, it appears. Now, the question is, I suppose if you look at it, if we provide revenues that are too generous, the legislature, this next session, acts on those and appropriates money for them, and then it doesn't come true, they end up in the cash shortage. And of course, if we do the opposite, then there's programs they could have established that they don't. Now, if you are in our position, you know, in December, we've got to come up with some estimates for 2.5 years. And given the risks that are out there, what recommendations would you give us for what you think we would do based on your knowledge of the economy and also, I suppose, the risks that's involved in any determination that we make?
Thank you. The risks that we're facing currently are very clearly skewed to the downside here. There's very little that could go right and could put us on a better trajectory than what we have in our baseline right now. There's some things, there's not that many. And so I think there is reason not to place a recession into the outlook just because there's still a lot of support in the economy, still because things are moving in the right direction. But I do think there's some cause to, I guess, handicap those outlooks a little bit, to slant things a little to the lower side because of these risks. It's a difficult position we're in. It's a difficult position you're in as well. Part of the reason that we're trying to synthesize every new piece of information that comes in to kind of see how this is shifting on a moment-by-moment basis, because that seems what it is. I think that a little bit of caution is definitely warranted in the current environment, but it is far from certain that we'll enter a recession right now. So I wouldn't recommend pricing that into your outlook at this point in time, but it's a different place.
I was hoping you could talk a little bit about the employment picture. Excuse me. I would agree with you. The forecast does seem, or the baseline forecast seems, I wouldn't call it optimistic, but certainly must be underpinned in assumptions around employment and things of that nature. Could you talk about the employment or unemployment levels that are factored into the forecast, the baseline forecast?
Yes, definitely. Thank you. So the employment picture currently is very strong. We have, I think, I don't remember nationally, I think in Nevada there's something like 1.6 openings for every person who's actively looking for work right now. And so there still is a significant amount of demand for labor. There's still a significant number of open positions out there. And there's still been fairly strong growth across across industries. To focus a bit more on Nevada, there's been very strong growth in a broad array of kind of private services, especially more white-collar services in Nevada. Seen some weakness, or at least some flatlining more in the leisure hospitality industry. But I think a lot of that is coming from just labor shortages, people not being able to find the workers that they want to hire, or at least not without putting huge pressure up on wages at this point. So our outlook for where we think this is going is that job growth is going to slow quite a bit. We have, I believe nationally, we have that the outlook will, businesses will essentially be adding only enough workers to prevent, I'm trying to think of the numbers here. Essentially, only adding workers slowly. We have the unemployment rate rising slightly in the forecast, at least, I think coming up by about 0.5 percentage point. And that's because we assume that labor force increase is increasing a bit faster even than businesses are adding workers. And so part of that is taking pressure off of wages. But the net result is we get a small increase in the unemployment rate. Job growth is significantly slower than what we've seen, but we still have positive job growth, if a bit slower.
Thank you. For the record, Linda Rosenthal, just a couple quick questions. In the near term, if we went into your first downside scenario and we did go into a recession, do you see that having an impact on the longer term through our forecast cycle, or do you see it kind of as a temporary impact and then we get back to your assumptions for growth in 23 and 24, or 24 and 25?
Yes, Madam Chair. I think that it would be, the timing of that, I think, is important. I think if we were to enter a recession scenario, it would be hitting us more in around the middle to the second half of next calendar year, right? Just because that's when this kind of the pressures we're seeing that would lead to some job losses. Because of this labor force strength that we've seen currently, I think it would take a bit of time for that to materialize. So that's around the timing we'd see. As far as whether we'd see the growth rates in the outlying fiscal years come back, I think yes, in fiscal 2025, but we would see some downside there in the interim. And then also the growth rates coming back doesn't mean that would be totally at the levels that we would see previously. I'd anticipate that we would have that near-term contraction, stronger growth even than the baseline as we get some of the recovery from that. Like I showed in this first slide, we wouldn't anticipate this would be a particularly deep recession there. But I don't think the levels would probably be totally back to the baseline level in the out year.
Great, that's very helpful. And then last one for me is just, we've talked about this narrow path that we're on to stay on the baseline and not dip into the downside scenario. We've talked about the fact that there's probably potential for bigger negative impact than positives with some of the potential drivers. Just how would you characterize how narrow that path is? Like, what kind of buffer do we have? I mean, are we just on the edge, and any one little downside scenario coming to fruition would cause us to go into the recession? Or do you think, excuse me, there's a significant amount of buffer there?
I think that the buffer is fairly small. I think that the most recent CPI report kind of reduced my recession probabilities, like internally. I think that was a move in the right direction. But any one number, any one report only changes things, so much. We can see a reversal of that later. So I think we're particularly susceptible to external shocks at this point in time. The real question is, how fast would businesses pare back on their positions if they felt like the economy was moving in a bad direction? Because we have seen some reduction in confidence recently, and as well as some industries that are more susceptible to interest rates. We're already seeing some contraction there, particularly in the housing sector, particularly in tech companies. So that hasn't manifested more broadly in the economy because other companies aren't as reliant on kind of the short-term financing, but it's definitely there's definitely risk there, and there's definitely some reduction in just confidence there. And I think if something else external went wrong here in order to further destroy that confidence, to make businesses even more wary than they are currently, then I think that could lead us into a recession scenario.
Thank you. More questions? Yeah, absolutely.
So in each of the scenarios you laid out, there's varying degrees of kind of bounce back in the economy. In the baseline, there's a moderate bounce back. In the moderate recession, there's a sharper bounce back. And in the stagflation scenario, there's an even sharper bounce back. Could you talk about maybe some of the drivers behind that and what some of the assumptions behind that are?
Yes. First off, I think it's important to reiterate that this chart one, is in growth rates, right? So despite the fact that we might have a stronger bounce back in those growth rates, it doesn't necessarily mean that in level terms we are back where we would have been without the recession. Harkening back to the chair's question earlier. The assumptions around it would generally be that in this moderate recession scenario, we would see businesses start to pull back on these payrolls. We would see job losses. But as the economy stabilizes, as the Federal Reserve then reduces interest rates from its current level, in our baseline case, we have interest rates staying high at their kind of terminal rate through calendar 2024. In a downside scenario, we would see interest rates start to come in sooner than that, right? Because there would be this downside in the economy, which would bring in inflation kind of on its own in the moderate recession scenario. We'd see that we'd start to get some stimulative monetary policy, which is part of the reason that we get that stronger recovery in the downside scenario. Now, part of the risk, there's risks to our risks here. Part of the risk to the downside scenario is that the federal government likely wouldn't step in with significant federal stimulus, fiscal stimulus at this point, just because of the outlays of the past couple of years have been quite large. And because we're entering a divided government situation at the national level, that would likely be on the smaller side. We'd still see some automatic stabilizers, things like Medicaid increasing, things like unemployment insurance coming into play that would, help stabilize, help prevent a steeper contraction in that. But we'd see the recovery would be driven more by monetary stimulus than fiscal stimulus at this point. In the stagflation scenario, the reason that we see a steeper drop there is because monetary policy, interest rates need to stay higher for longer because inflation has become so entrenched in that scenario. And that's part of the reason that we see this growth remaining negative for longer, because there isn't really that stimulus, there isn't really that momentum to kind of bring us out of that sooner. And so we eventually get a stronger rebound once inflation finally does come under control in that scenario, which is why we see that stronger growth there. But it's slower and it's really much more damaging in the process.
Okay, I think we're all set. Do you want to move on to your revenue outlook? Thank you.
So we discussed this a little bit earlier, but to kind of shift things into a Nevada focus here. The Nevada labor market is quite healthy at this time. Just like with the national economy, and honestly even more dramatically in a way, Nevada's bounced back from this recession. Nevada was hit especially hard at the start of the pandemic, and it's really made huge progress in coming out of that. Total employment is higher than where it was before. Unemployment rate is very low right now by historical standards. That's the green line here on this chart. And then we also have the blue line here on this chart, which is job openings, which I keep talking about here because it's been a major hallmark of this economic recovery, just that we have this huge amount of job openings. We have this kind of unfulfilled demand for labor at this moment in time. And so we've started to see some of that come in. We've started to see openings come in, which, to be honest, is what we want at this point. But the labor market still remains in very strong shape. And that's part of what's going to underpin my revenue projections that we're going to talk about in a minute. Under the baseline scenario that we've laid out here in these projections, it's a very similar story to the United States in that we see slower job growth, small increase in unemployment as that job creation doesn't keep up with the labor force growth, but still moving slowly in the right direction. So in our outlook for sales and use tax revenues, we've had absolutely massive growth by historical standards in the past 2 years. 9% growth in fiscal 2021, followed by almost 22% growth in fiscal 2022. Now, this was much stronger growth than we had anticipated in our prior revenue outlook. Part of that's coming from stimulus, part of that is coming from the really strong recovery we've seen kind of in tourism, in people moving to the state, and consumer spending here. And then part of that is also coming from inflation. Because these sales tax collections are nominal terms, the higher that the price is of the good that you buy, the more those associated tax collections are going to be. So we have, for our outlook, is fairly strong growth of 8% in fiscal 2023. We have growth gradually declining, slowing throughout the course of that year as we get some of this slowdown in the broader economy, and then remaining around that 5% level through the next 2 fiscal years. There are 2 major positives, major supports for these revenues. First of those is what I discussed previously, is inflation. We have inflation nationally at around 8% in calendar 2020, it's still 2022, I keep thinking it's 23 already, calendar 2022 coming down to around 4%. So really that growth is basically keeping on track with inflation, at least in the near term. The other positive there is the labor market. We've seen some strength in the Nevada labor market, like I just discussed. We also have strength in Nevada's population. A growing population is a huge and probably the main driver of increased sales in an economy. On the negative side there, though, is demand for credit is going to be constrained by higher interest rates as credit gets more expensive, both for households and for businesses. That's pulling in some of that. And then also, labor market is strong currently, but starting to cool a little bit, so getting some cooling there. This next chart is just a chart of historical population growth in Nevada, because this population growth has been one of the main supports of consumer spending. The 2 drivers that we use for this sales and use tax forecast are personal consumption expenditures, so just spending by households in Nevada, as well as wage and salary income. Personal consumption expenditures have been supported by both inflation, like we talked about, population, as well as that chart we talked about earlier about the huge amount of cash in the economy. That chart I showed is at the national level, because unfortunately we don't have a Nevada level data for that, but I imagine that the situation is very similar. Wage and salary income, in turn, has been driven by the tightness in the labor market. That's put a lot of pressure on wages. We think some of that growth is going to come in, but it's still remaining positive. It's still supporting it, but not to the degree that we saw over the past 2 years when we had those really massively strong recovery in sales tax revenue. Okay. We also think that as people start kind of eating into their savings a bit, as people start bringing up some of those credit card balances, maybe not the healthiest way to finance growth, but we're seeing that, and that's going to be another thing that is driving spending as people keep spending through these impacts of higher prices. Because a lot of the areas that we're seeing higher prices aren't exactly avoidable. Things like automobile prices, things like spending prices for different goods. Those are things that lower income households or middle-income households still need to put this funding towards. A lot of those still have money in reserve, but they will also rely more heavily on loans, on lending, in order to keep those spending afloat as the economy gets a little bit weaker. Did you want to discuss the sales tax outlook, or do you want me to go over into the gaming tax and then come back to this?
We can pause real quickly if anybody has any questions on the state sales tax. Otherwise, we can move forward. Okay.
Sales tax to me is kind of a difficult one because it involves so many different complexities. One, it looks like, we have the situation where almost daily consumption. You know, you buy things for use immediately. And that's one component of it. Of course, the next component of it is when you're going into debt for something that you expect to pay off over the next several years. Now that is somewhat dependent on an individual's perception as to what's going to happen in the economy. And then, of course, if we've got the construction expenditures, which are driven by, I suppose, perception, as well as interest rates, of course, where they're borrowing money from it. So we've got all of those sort of a mix coming together in the sales tax, sort of a unique, in a way, a unique tax for all of the ones that we've got. And I just wonder, as it relates to these expenditures where someone's view of the economy drives what they expend, what's your feeling as to how people now are viewing that portion of the economy and how that will translate to sales tax when it comes right down to it?
Yes, thank you. I think it's a good question. There's a lot of moving parts that we're looking at this right now. I think we've seen some contraction in just consumer sentiment surveys. Some of that feeling about the economy has started to come in, but we haven't seen a similar change to actual spending habits. So I think at least in the current environment, in some ways, people are spending differently than at least how they're saying they feel about the economy. So we've got a bit of a divergence there. There's a question of how long will that hold up, but at least for now, spending's been very resilient. Even part of this has been honestly going past expectations. In the wake of the pandemic, people stocked up on a huge amount of goods. They refurnished their houses. They bought their patio furniture, things that would make their, under quarantine lives better. And we have kind of expected to see a stronger shift towards spending on services away from spending on goods than we've seen at this point. People have spending on goods has been very resilient. We have a slowdown in that spending baked into the personal consumption expenditures forecast that we use as a driver in this model, that it's slowing. But at least for the time being, people have shown through their actions that they're going to keep spending, keep buying. That has remained quite strong, even as some of these perceptions of the economy and the risk have kind of increased. I think a lot of that has to do with the strength in the economy right now, the strength in the labor market. It's hard to feel, I should pull back on my spending when I still have a job and when wage gains have been relatively strong. So there's a lot of moving parts, like you mentioned, as part of this. At least for now, consumers have been very resilient. We expect some slowdown of that spending, but for now, resiliency is definitely the key word here.
Thank you. We can go ahead and go to the percentage fee tax.
So this one is a bit different. You'll see that the growth rates in this forecast are definitely lower than what we're anticipating under the sales tax forecast. We kind of similar in a way to the sales tax forecast is we saw massive rebound in spending coming out of this pandemic. Gaming percentage fee revenues rose 10%, almost 11% in fiscal 2021, followed by over 40% in fiscal 2022. This is significantly higher than what we had forecast a year and a half ago. Part of that is, honestly, people really had a huge amount of pent-up demand for vacations. They had a huge amount of pent-up demand for these kind of recreational activities, for coming to Nevada, coming to Clark County. And so we've seen some of that manifest in this huge growth. On the other hand, there is people wanted to take these vacations, and they also had the money to take these vacations. Through this stimulus funding, through this stronger growth in the labor market, people have had the financial resources to be able to spend this money, to be able to come to Nevada, and that has really increased these revenues here. Now, we don't think that this is going to keep growing at anywhere close to the pace it's seen. We're expecting that these revenues will retrench a little bit. Gaming percentage fee revenues have always been more sensitive to the business cycle than sales tax because it is more of a discretionary spending. And it also is more reliant on on tourism, right? Sales taxes, we have this, this statewide base for spending, right? You have your growing population, you have the people who live in Nevada who are going to keep spending. But for gaming percentage fees, that has some more variation depending on who's coming into the state, how that tourism is playing out. And so we expect that these revenues will remain near their current levels, but we are forecasting a small decline in fiscal 2023 as people become a little bit more cautious as some of the pent-up demand has already been satisfied. We then expect them to remain around constant in fiscal 2024 before beginning to resume that growth that we saw previously in fiscal 2025. A lot of our forecasts have this, even under our baseline, which, like we've been discussing, is a no recession scenario, it still has a bit of a cyclicality built into that there, where we're expecting slower growth over the next couple years, followed by stronger growth as this current tightening cycle winds down. And so this is partially what you're seeing reflected in these gaming percentage fee forecasts. Okay. Unlike sales tax collections, where inflation is in some ways a support for the forecast because it's increasing the prices that people are spending, as people are feeling more pressed by inflation for rising prices for energy, for food, for other goods, that's leaving less money available to spend on revenues that would be captured by this gaming percentage fee. The other factor that I wanted to draw your attention to here is that we're really fairly pessimistic. We're not on the outlook for international visitors. They've already been slower to return here. You can see that the blue line here on that chart is international visitors to Harry Reid International Airport versus domestic travel, which is basically totally recovered. So it's already been slow to come back, and the global economy is facing significantly more pressure now than it has been maybe a year ago. That's coming from, honestly, in large part from these higher energy prices. They're hitting Europe a lot harder than they're hitting us. We're also seeing a slowdown in China in terms of growth there. And so all of that means that the global economy is going to be weaker for the next several years than the United States economy. The other significant factor here is that the dollar is exceptionally strong right now, and we expect it to remain strong by historical standards over the next few years. A stronger dollar is a headwind for gaming because it increases the cost of a United States, a domestic vacation, relative to spending that could be done overseas. And so this is definitely going to be a headwind here, and we don't see this abating anytime soon. This has been driven both by the Federal Reserve's tightening process as well as a flight to quality as we see stronger performance in the domestic economy. So this is going to remain a headwind for the next several years for that gaming percentage fee forecast. Okay. With that, I'm happy to take any additional questions.
Thank you very much. Any questions from the forum members? Mr. Crum?
Hi, for the record, Michael Crum. You talked about the international visitors. I didn't understand what your forecast predicts for them in the future. And maybe I just missed it. Can you talk about that?
Yes, thank you. We don't specifically, this isn't a series we specifically forecast, but it's a part that's playing into this recreational spending that is a driver for the revenue forecast. We have, the baseline would be that it's fairly weak. We don't expect that this to come back in the near term, and part of that is coming from this stronger dollar, part of this coming from this slowing global economy. So we do think that this will resume eventually, but eventually has, a pretty long possibility of when that is. I think probably around that fiscal 2025 would be the benchmark that I would expect for when this is really going to pick up again, because for the next several years, there's just there's a lot of headwinds to this visitors. Yeah.
Thank you very much. Appreciate your presentation today. Okay, moving on to agenda item number 5, we're going to have a presentation of historical taxable sales and gaming market statistics. This will be presented by Russell Ginden.
Thank you, Madam Chair. Sorry, I just need to confer with Ms. Mendel as to her schedule as we move forward in the agenda. And so, as you're probably already familiar with, on this agenda item, there are numerous charts and tables that have been part of the economic forums process for over a decade. And so I don't plan on going through them. They're there for the members and or the public to look at. They have been updated to include one more month of the gaming market statistics that the Gaming Control Board reports each month, and then the taxable sales numbers that the Department of Taxation reports since this body met in October. The commerce tax tables are the same from last meeting. We just rolled them over because that's a fiscal year tax, so we only get the information annually. And so they are there. And again, if there are any questions of this body as we go through the agenda today, that the tables might be useful, then Madam Chair and members, we can pull them up and make use of them. But again, that's all the information that I wanted to provide, that's the same set of charts. They've been updated with an additional month. And we will continue, we'll update them for the December meeting with an additional month of data for both the gaming and taxable sales. And with that, Madam Chair and members of the forum, I can answer any questions on this agenda item, if there are any.
Thank you, Mr. Ginden. For the record, Linda Rosenthal. Seeing no questions, I think we'll move to agenda item number 6. This is the review and discussion of the preliminary forecast of major general fund revenues for fiscal 23, 24, and 25. Before we begin this agenda item, just given where we are in this economy and the uncertainty ahead of us, in particular in this forecast cycle, I want to get a better understanding of the underlying assumptions of each forecaster, similar to what we did with Moody's Analytics. So I would like to ask each forecaster to provide information on their general assumptions or outlook that they used in developing their forecasts for the various revenue sources. This information doesn't necessarily need to be provided on the presentation for each revenue source, but more just a general overview on their views of the economy, the outlook for the future, and any specific assumptions used in creating their forecasts that will help us understand the context behind those forecasts. So with that, we'll start off with agenda item 6A, which is our first tax, the gaming percentage fee tax. And I believe we'll start with a presentation by Mr. Lawton.
Yeah, Madam
The
Chair,
taxation.
for the record, Russell Ginnen, if I may, just again, as I have historically done, and yes, so Mr. Lawton and Mr. Gotard can come to the table for this, start with the percentage fees. But I just wanted to go through quickly the various tables and information that's inside and outside the packet for the members, but also for the public that may be listening or watching over the web. So what you have is that you have clearly outside the packet, there's separate handouts that have been prepared by the Budget Office, or I may end up saying GFO, the Governor's Finance Office, Taxation, the Gaming Control Board, and Fiscal. So you have those 4 as separate items outside the packet. Then inside the packet on page 35, you have the actual table that shows the actual collections for the last 3 years, and then fiscal year to date for every revenue source, just in case reference is needed. And then on page 45, you have table 3. That is the table that compiles for each unrestricted general fund revenue source, the forecast by forecaster. That is the agency that's responsible for administering and collecting that tax, and then the one prepared by the Fiscal Analysis Division, and then the one prepared by the Budget Office. And so then as we get into those the minor revenues that are in that table, we'll get to another agenda item with regards to the Technical Advisory Committee. And so that begins on page 45. On page 53, beginning in the packet, you have table 4, which just shows by forecaster, including Moody's for sales tax and gaming, the forecast for each of the 3 years for the major general fund revenue sources that this body will be considering today. And then finally, on page 57, you have table 8, which is also on green paper outside the packet. This is the table, especially for the 2 new members, that where we're showing you the forecast by forecaster. But then as we add the December forecast, we'll bring this table back, and that allows you to see the compare and contrast not only across the forecasters for each revenue source, but how those forecasters may be changing their forecast between November and December. So I just wanted to go through that, what we're doing there. And then beginning on page 65, you have tables for the modified business tax. And we did this actually 4 years ago to show with the MBT, because it has the tax rate reduction due to the rate reduction calculation provisions. So there's a set of tables there that show the MBT without the rate reduction and then with the rate reduction. And then we'll cover that more when we get into that revenue source. And then on page 67, you have tables 1, 2, and 3, which is information for the commerce tax forecast, with page 70 being the actual commerce tax consensus forecast. And then what you have is there's the colored line charts that we've added as a new document for this meeting that takes the major forecasts, revenue sources by forecaster, and puts it graphically as well as, because we have numerous tabular formats for it. And so, and then we have, as I said, table 8 is the green outside. And then with Madam Chair, that was the stuff I wanted to go to this agenda item. When we get to the minor or technical advisory committee, there'll be some additional tables I want to reference. And with that, Madam Chair, we can proceed. And then I will attempt to run the slides for each presenter. And so if they can just sort of let me know, I will try and watch and keep tabs. Thank you.
Good morning, Member Rosenthal and members of the Economic Forum. For the record, Michael Lawton, Senior Economic Analyst with the Nevada Gaming Control Board. It is good to be back in the building. It's good to see us face to face and have these discussions. Happy to be here. Per Chair Rosenthal's request, before I get into the nuts and bolts of my numbers, I have a brief statement. I don't know how brief it is, but on some of the major assumptions we have for gaming win. I'd assume my assumptions for the gaming LET I could provide when we get to the LET forecast. So our forecasts are built on the assumption that statewide gross gaming revenue will peak during FY23, and the catalyst for this growth will be the Las Vegas Strip, which is hosting various distinctive special events and conventions during the next 6 months. These events include an Elton John concert, which already occurred at Allegiant Stadium on November 1st, in addition to Adele beginning her residency at Caesars Palace later this month. Moving into calendar year 23, the Las Vegas Strip will host 2 large citywide conventions, the CES show in January and the Con Expo Con Ag show in March. These 2 conventions are not expected to be negatively impacted by a surge of COVID-19 cases, as was experienced during the beginning of calendar year 22 due to the Omicron variant. Additionally, T-Mobile Arena will host Sweet 16 and Elite 8 NCAA men's basketball tournament games in March of 2023. Moving into 2024, other noteworthy special events are on the calendar as well, which include the opening of the 17,500-seat MSG Sphere Arena with an opening performance by U2, the F1 Las Vegas Grand Prix, and of course, the 2024 Super Bowl at Allegiant Stadium. The models have obviously taken these events into consideration, in addition to an expected moderation in the current levels of gaming win due to an anticipated pullback in consumer spending as a consequence of inflation, rising interest rates, and volatility in the stock market. With the Federal Reserve attempting to lower inflation by ongoing interest rate hikes, the gaming industry continues to look for signs of a slowdown in consumer spending. Although these trends have not surfaced yet on the Las Vegas Strip, it would seem reasonable to assume some impact over time on leisure spending. As these two conflicting variables converge, a realistic outcome, in our opinion, estimates that gross gaming revenue could decrease somewhere between 5 to 10% during FY24 and 25. Under this scenario, gaming win amounts would still be in a range of between 12 and 18% above pre-pandemic levels of gross gaming win recorded during FY19. That's my overall statement. I can answer any more questions after, but I'd like to get into the actual revenue forecast, if that's okay. During my discussion, obviously, I'll be referring to a set of charts of which you have received a copy. In forecasting percentage fee collections, we first forecast gaming win for the applicable fiscal years, convert that into taxable gaming win, and lastly, into percentage fee collections. We project growth rates for the state's 16 individual major markets, such as the Strip, Las Vegas Downtown, the Las Vegas Locals, Reno, Elko, South Shore, Lake Tahoe, etc. Any new properties are incorporated into our models, any property expansions, and known or anticipated closings as well. This is done through a review of trends and, more importantly, through interviewing some of the individual properties in the various markets. We also get input from several Wall Street analysts, from the Research Department of the Las Vegas Convention and Visitors Authority, and the Nevada Division of Tourism. The sum of these individual market forecasts produces an estimate of total statewide gaming win. Within these markets, we also forecast slot win and games win separately. So my first chart, which is up there, is the outline for the state of Nevada's gross gaming revenue for the next 3 years. For FY23, the forecasted gaming win total is $14.7 billion, which is an increase of 1.3% over FY22. FY22 represented the highest win total all time in state history, with $14.5 billion in win. Currently, fiscal year to date, the state is up 3.8%, or $184.4 million, and for the remaining 8 months of the fiscal year, we are facing a growth rate of 35.2%. As I assume you know, Nevada has registered 19 consecutive months going back to March of 2021 of gaming revenue in excess of $1 billion, with no clear sign of this streak ending anytime soon. We can safely assume that this is a long-term trend, and looking back at FY19 as our base year has become very unrealistic. In our opinion, the base is FY22, and we will either increase or decrease off of this fiscal year moving forward. The state's record level of gaming win over this time period can be attributed to several factors, including stimulus, steady demand for gaming-related activities by resilient customers whose behavior has remained consistent in the face of several challenges, which include record levels of inflation and fuel prices. Additionally, Nevada has continued to benefit from the surging demand in leisure travel, both domestically and internationally, and a healthy local economy experiencing record employment levels. For FY24, the board is forecasting statewide gaming win to total $14.2 billion, which is a decrease of 3.7% from FY23. During this fiscal year, we are anticipating the opening of the Fontainebleau Las Vegas and the Durango Station. We are also anticipating the remodel and rebranding of the Mirage to the Hard Rock to begin in FY24 as well. In FY24, the board is forecasting statewide gaming win to total $14 billion, which is a decrease of 1.5% from FY24. We are not anticipating any new property openings during fiscal year 25. Moving to my next chart, the Las Vegas Strip's forecasted gaming win total for FY23 is $8.3 billion, which is an increase of 3.5% over FY22. Fiscal year to date, the Strip is up 7.6%, or $202.2 million. For the remaining 8 months of the fiscal year, the Strip is facing a growth rate of 60.6%. As the chart illustrates, gaming win on the Strip is also at all-time record levels. The totals are being driven by the factors mentioned in the previous slide, as well as multiple signature special events which have occurred since June of last year. The sports and entertainment calendar has been incredible during this time period, and it has included numerous concerts, residencies, music festivals, and multiple high-profile sporting events. The Strip has truly become the greatest arena on earth. In FY24, the board is forecasting the Strip's gaming win to total $8 billion, which is a decrease of 3% from FY23. For FY25, the board is forecasting the Strip's gaming win to be $7.9 billion, which is a decrease of 1.9%. As I stated earlier, in forecasting gaming win, we prepare a separate forecast for slot win and game and table win for each market. Starting with our forecast for slot win, I think, Russ, you have the chart up, yes? Slot win began to recover in FY21, and in 22, slot win recorded its highest win ever with $9.8 billion in win, which was driven by near record volumes in FY22 with $136.8 billion in coin in. To put things into perspective, the slot win figure for FY22 is 17.7% above the all-time record win amount established in FY07, which was $8.4 billion. For FY23, the board projects slot win will be up 0.5% this year, totaling $9.9 billion. Fiscal year to date, slot win is up 1.5% or $48.4 million, and volumes are up 2.9% or $1.3 billion. The comparison over the remaining 8 months is an increase of nearly 30%. In FY24, the board is forecasting slot win to decrease 4%, with a total of $9.5 billion in win, and down 1.4% in FY25, with $9.4 billion in slot win. The business activity the state is experiencing in slots remains stable. However, as comparisons have become more and more difficult, several markets have started to record decreases, and we anticipate that slot revenue totals will begin to level off and decline in FY24 and 25, and as consumers continue to face mounting headwinds. Just as an example, fiscal year to date, downtown slot win is down 7.7%. North Las Vegas is down 1.7%. Laughlin is down 5.3%. Boulder Strip is down 5%, and the balance of Clark County is down 2.5%. My next chart outlines game and table win. Game and table win did not begin to recover until FY22 due to its reliance on the Las Vegas Strip, which lagged other markets in FY21. This was due to table games' dependence on special events and domestic air travel. However, as you can see, game and table win recorded its highest total win ever in FY22, with $4.7 billion in win, which was driven by near record volumes in FY22, with $26 billion in drop. The game and table win figure in FY22 was 6% above the all-time record win amount established in FY14, which was $4.4 billion. Although not as robust as the slot win tables, games win amounts are still very impressive when you consider a key component of table game win, which is Baccarat, is not at record levels due to its reliance on international players from the Far East. In FY14 at its peak, Baccarat win totaled $1.6 billion. In FY22, Baccarat win totaled $1.1 billion, which was $511 million or 31.8% below the peak. For the fiscal year, Baccarat is currently up 21.2% or $80 million, and volumes are up 8.3% or $215 million. Baccarat this fiscal year so far has benefited from an elevated hold percentage of around 16.3% compared to 14.5% this time last year. On the non-Baccarat side of the ledger, non-Baccarat game and table win set an all-time record in FY22 with $3.6 billion in win, which was up 4.6% above the all-time record of $3.4 billion set in FY07. For the fiscal year, non-Baccarat win is currently up $56 million or 4.9%, while non-Baccarat drop is up 4.6% or $366 million. For FY23, the board forecasts game and table win will be up 2.8%, totaling $4.8 billion. Fiscal year to date, game and table, I already mentioned that, I believe. Fiscal year to date, game and table win is up 8.9% or $136.1 million, and volumes are up 5.5% or $581 million. The comparison growth for the next 8 months is an increase of 48.1%. In 24, the board is forecasting a decrease of 2.9% in game and table win, with a win total of $4.7 billion and down 1.8% in FY25 with $4.6 billion in win. Similar to slot win, the business activity the state is experiencing in games and tables remains solid. However, the comparisons for the Las Vegas Strip are becoming more and more difficult, and due to potential softness in consumer spending, along with the always somewhat uncertain outlook for international baccarat play, we expect game and table revenue totals will begin to level off and decline in 24 and 25 as well. As I stated, when we forecast gaming win, we convert our forecasted win totals to taxable gaming revenue, and this next chart outlines the taxable gaming revenue forecast, which is very similar to the trajectory that we have for total gaming win. In FY23, the board projects taxable gaming revenue will peak at $14.2 billion, which is 0.4% over FY22's record total, which was $14.1 billion. Fiscal year to date, gaming revenue was up 4%, or $186.4 million. The comparison for the remaining 8 months for taxable gaming revenue is an increase of 36.9%. Not displayed on this chart, but I wanted to discuss briefly is the current ratio between gaming win and taxable gaming win. It's currently sitting at 96.6%, and we are forecasting that ratio to come in at 96.3% in FY23, and to continue to decrease slightly in 24 and 25 to levels that are higher than our pre-pandemic ratios, but slightly lower than what we have recorded in 21 and 22, which averaged around 97.1%. We expect this key ratio to decrease due to the sustained increases in credit issues, which are beginning to average pre-pandemic levels. In FY24, we are forecasting a decrease of 3.8% with a total taxable gaming win of $13.6 billion and down 1.5% in 25 with $13.4 billion in taxable gaming revenue. Lastly, getting to actual percentage fee collections is my next chart. For FY23, the board is forecasting $928.5 million in collections, a decrease of 3.7% or $35.7 million from FY22's peak total of $964.2 million. Currently, fiscal year to date, with 4 months reported, total percentage fee collections are sitting at $325.3 million, or down 1.5% or $4.9 million. The comparison for growth over the remaining 8 months is an increase of 25.3%. As you know, there's 2 components that make up percentage fee collections. First is the percentage fee collections on taxable gaming revenue, which fiscal year to date are total $320.5 million and are up 3.2% or $9.9 million. The estimated fee adjustment is the other component, and fiscal year to date it is sitting at $4.8 million and is down 75.5% or $14.8 million. FY22, the EFA collections totaled $33.7 million and represent a very difficult comparison for our models this fiscal year. As you know, the EFA is the difference between the amount of gross gaming tax revenue, the amount of tax due on the gross gaming revenue for the current month, less the amount of tax paid 3 months prior. Due to record levels of gaming revenue growth the state has recorded in FY22, EFA collections have been a positive contributor to the state's record level of percentage fee collections. However, as our models have revenue totals beginning to moderate in FY23 and slightly decrease in 24 and 25, EFA totals are expected to decrease as well. FY23's forecasted decrease in our models in percentage fee collections is almost entirely due to the forecasted decrease in EFA collections from $33.7 million in 22 down to a negative $532,000 in FY23. FY24, the board is forecasting percentage fee collections of $878.8 million, a decrease of 5.4%. And in 25, the board is projecting percentage fee collections of $878.6 million, which is just a slight decrease of 0.01%. That concludes my discussion. I'll be happy to answer any questions that you might have.
Thank you. Any questions?
I was going to ask you, what is your prognosis? You mentioned the 2 conventions next year, but do you see the convention business recovering and making a dent on the gaming tax, or no?
For the record, Mike Lawton, Nevada Gaming Control Board, the midweek business is soft compared to where we want to be, where we were pre-pandemic. It's expected to continue to grow and increase. And I believe by the end of calendar year 23, we could theoretically be back to close to where we were in that pre-pandemic period of FY19. It's not quite there yet, but we really have a strong sense from discussions with licensee personnel that first quarter is going to be very good for the Strip. I don't know, there's so many things that have happened, but I don't know if you recall, first quarter FY22 was disappointing. We really expected to come out of the gate strong, and then there was severe weather on the East Coast, Omicron, and CES fizzled. It wasn't what we had anticipated. Con Expo, Con Ag, that's a different convention because it only comes every 3 years. So that first quarter with those events that we had mentioned, we expect the calendar year to get off to a really, really good start.
Thank you. And then my other question, and I think it's too early to tell, is obviously there's a lot of optimism for 2024 on live entertainment tax. But I know I'm always thinking that someone's going to surprise me even more. Like, I don't think I've ever dreamt of seeing Formula One pop up. But do we know there's not something even more spectacular than that for 2025? And it might be someone else knows more about it than it's been shared. I was just kind of, I know in the past we've had, performers retire. Like, I remember thinking, oh, wow, we're going to really be devastated when Celine
Who was supposed to
retired.
come back at some point.
But it turns out like it's been pretty impressive. The other people they've found,
Yeah.
they're even maybe generate more
Yeah.
tourism. Is there a possibility for 2025, or is it just too early to fathom?
I think it's too early. As Vince knows, these announcements are happening in real time. We just got an announcement about Garth Brooks from May to November of 2023. I don't have that in my model. So when I come back to you in December, I'm going to have to address my LET model because I didn't have that. And to your point, I know we're getting a little bit into LET. It's such a hard tax to forecast because the ability for us to know what's coming online in FY25, it's not there yet. We just found out about Garth Brooks, and that's, 8 months from now. We definitely don't know what's coming online in FY25 in terms of performers, and are those performers going to match the magnitude of the performers we had in FY23?
I think it's just a leap of faith, I guess.
Yeah.
But no, I was just curious. Well, thank you.
Yeah, you're welcome.
Could we talk about international travel for a minute? I recall here several sessions where where international travel is an important part of our discussion, where the growth in tax was somewhat dependent on where we stood on that. Now of course, it's really dropped off. What do you see happening, or where are we currently as it relates to international travel, and is it coming back, or where?
I think there's been some nice increases in international travel, Canada, Central America, Mexico. In terms of international travel, where I concentrate on it, Baccarat. I'm amazed how Baccarat has performed through all of this without, necessarily this great relationship the Macau casinos have in building new customers. The new customers come here. It's really not there with COVID-0 in China. I've had discussions with properties that are in the Baccarat business. They really didn't give me any sense on when they expect that portion to necessarily come back like it once did. But the Baccarat business has not necessarily been a drag on gaming revenue. As you can see, it's off from its peak. But our understanding is that there's customers that have multiple residencies in the States. They might not have come home. There's been domestic play that's been very strong on the Baccarat side. So it's been held together nicely. I'm honestly, I've spoke to you before, I'm glad we're not relying on Baccarat. when we rely on baccarat like we did in FY14, it's the swings are so large with hold, and then we start giving up taxable gaming revenue because of the discounts and the deals that are made with these customers. So I like where baccarat is right now. I don't know if Vincent does, but I'm comfortable where it is. It doesn't keep me up so much as at night. Now, of course, there's other things that we worry about, but yeah, baccarat business has been a pleasant surprise. I don't think moving forward in my forecast models, I'm relying on it to save the day. Obviously, I'm forecasting some softness, and I don't have the baccarat business coming back and saving it because no one's telling me that that's going to happen. If they did, I would possibly change the trajectory of what we have here today.
Well, thanks for the presentation, Michael. I think it's been terrific, and I appreciate your balanced, approach and outlook to this. I know you have an immense amount of experience, in your role with the Nevada Gaming Control Board. Since it's such an important component of our budget and forecast, could you kind of draw on your experience and think about a downside scenario and where things could go in a downside scenario?
I think the board's forecast is optimistic with a pretty good splash of pessimism. I guess we could go. I have a drop of about 5% in 24-25 for the state. I guess it could go down to 10. Again, my models rely so much on relationships, human intelligence with not only the individuals on the strip, but in all the markets. And I don't get a sense that anyone's telling me the bottom's going to fall out, which that makes me feel good. I think I had some assumptions going into a lot of our meetings where I thought what they thought they might tell me. And I was pleasantly surprised and relieved that they're weighing everything that we're weighing too. You have this incredible events schedule. You have strong employment, but then there are these headwinds, right? And I think there's a balancing act, and maybe I balanced it more to the pessimistic side. I think there's upside to my forecast, as Moody's pointed out, if this narrow path, we have this soft landing. I just wasn't willing to necessarily forecast a soft landing because I think most of my research and intel gathering led us down the path of expect some softness. The Nevada Division of Tourism recently provided us with some surveys from a market research firm. Expectations on United States economic recession, 65.5% of the respondents agree or strongly agree. Reduced expenditures on travel due to recession concerns, 78.9% agree or strongly disagree, or agree or strongly agree. Personal financial concerns regarding upcoming recession, 67.6% agree or strongly agree. So I think that kind of pushed me into being more pessimistic than maybe optimistic. And I guess there could be some more downside risk for me, but I think the way I balanced it things, there could be some upside, and I could be wrong on being too pessimistic. I hope that answers your question. It was a lot.
Sorry, for the record, Michael Chrome. Just wondering if your model takes into account any other domestic markets opening up, and that could be a potential drag on less tourism because we're seeing other gaming markets open up, and if so, how does that factor into your model?
I really, Member Cohn, for the record, Mike Lawton, Nevada Gaming Control Board. I really didn't. I guess there could have been some concerns regarding legalized sports betting in California. That could have dragged some business. I mean, the damage to the gaming industry in Nevada, if you could call it damage, from other jurisdictions, it's mainly happened in the northern part of the state with Native American gambling in Northern California. That's already done its damage. Reno and Washoe County has become such a great hybrid of some regional tourism along with this booming local economy. So yeah, I didn't take any of that into consideration in terms of another market hurting our business here in Nevada. Our special events, as you know, no one, even close, right? I mean, it's just, I'll have months where I'll report and I'll read, I keep track on a calendar, and I'll say, how did they do this all in one weekend? It's just incredible. So.
For the record, Linda Rosenthal, so just one quick question. You laid out some of the events in '23 and in '24 that are all very significant. In your model, are those relatively equal so that the decline in '24 is really based more on consumer behavior excluding these wonderful events, or is one heavier weighted than the other? I don't know how convention business and
Yeah.
certain concerts compare to, Super Bowl and the car race, but
I think in the models, this is from discussions with the guys on the ground. That first quarter, everyone's really, really excited about with those two conventions, and then the Sweet 16, Elite 8 tournaments. Those are going to be very big. I think, expectations with events. I know we had the NFL draft, and everyone was thinking this is going to be the greatest thing ever. It really wasn't. It was great for some tourism metrics with rooms and food and beverage, but it really didn't spill into gaming. I don't think that'll happen with the Super Bowl. I really didn't get in a lot of discussions with the impact the Super Bowl is going to have on gaming revenue. I can tell you everyone is very excited for the F1 race in November. They are probably more excited about that than anything that we talked about in terms of the events. So I think if you look at the quarter, that first quarter of 23, they're very confident. I think the fourth quarter of 23, they're very confident. I think that in the middle, there's some, hey, maybe there's going to be some kind of events that aren't going to be able to match and keep up at the pace that we're on. So I would say if the events are weighted, it would be F1 and then that first quarter convention calendar. And I don't know if it's so much the convention calendar. You got to realize that first quarter of 2022 was soft for the Strip. They did not have their best months possible. So they're really expecting, because those comps are easier, they could hit it out of the park. So, and just another thing, we're going to come back to you next month. I'm going to be, from what we're hearing, that October might be the best month ever. It might beat July 2021. So, the beat just keeps going on.
thank you very much.
You're welcome.
I don't see any other further questions for you, so now we'll move over to the presentation from the Budget Office. Welcome.
Thank you, Madam Chair, and welcome Economic Forum members. My name is Jason Gortari, Executive Branch Economist for the Governor's Finance Office. At the direction of the Chair, I'll first provide a general outlook on the economy and the assumptions that were made when I developed my revenue forecast. So my general outlook and assumptions that were used in developing these forecasts are that the feds will get a handle over inflation over the forecast period. I also made the assumption that employment and wages will continue to grow and the unemployment rate will remain relatively steady. My estimates also assume there will be a slowdown in the economy on the back half of fiscal year 23 and the start of fiscal year 24, and then the economy will pick back up for the remainder of the forecast period. And consumers will continue to spend, whether that be through wage increases or unrealized savings from the continuation of the hybrid work model. With that being said, I'll jump into my gaming percentage fees forecast methodology. Please refer to slide 3. My gaming percentage fee forecast relies heavily on expected gaming volume and gaming win. I separated out slots, baccarat, and everything else for statewide gaming volume. When discussing the broader economy, consumer confidence remains relatively low right now and interest rates remain relatively high. However, jobs continue to be added and the unemployment rate remains low. As of October of 2022, the U.S. unemployment rate is at 3.7%, up from September's 29-month low of 3.5%. As a result, I have statewide gaming volume dipping slightly in fiscal year 23 and 24, and then increasing in fiscal year 25. Please turn to slide 4. My forecast assumes that international business and convention travel will continue to improve over the forecast period. In my forecast, the gaming win is a mathematical function of historical relationships between win and volume. And the expectation for the forecast period is that that historical relationship will hold. Next, turning to slide 5. Slide 5 shows key metrics on how the gaming percentage fee collections are derived in my forecast. The win to drop ratio is higher than normal in fiscal year 23. For fiscal year 23, this ratio is forecasted at 8.5%. Then the win to drop ratios for fiscal year 24 and 25 reduce slightly and are in line with recent historical data. The gross revenue to win ratio for fiscal year 23 is lower than it's typically been at 92.2%, but for fiscal year 24 and 25, those ratios are predicted to be 96%, which is in line with historical data. Next, please turn to slide 6, which contains my gaming percentage fee collection forecasts. Collections are estimated to total $934.9 million in fiscal year 23, $907.6 million in fiscal year 24, and $935.8 million in fiscal year 25, moderately decreasing in the first 2 fiscal years and then increasing slightly in the last. And with that, that concludes my gaming percentage fee collections forecast. If there's any questions, I'd be happy to answer them.
For the record, Linda Rosenthal, just one quick question. You pointed out the total gross revenue to win ratio in 23 being low, very low. Do you know the main drivers of that?
The main driver year 23 is a lower Baccarat win number.
Thank you.
You're welcome.
Sorry, one more question on that then. So because that's what you've experienced to date, or that's what you're expecting? I mean, it's still, we have still ways to go, right, to get to the end of June of 23?
Thank you, Madam Chair. For the record, Jason Gortari. Yes, that's what we've noticed year to date. That number's down a little bit, and I expect that to continue with the international travel being down about 18% so far.
Thank you very much. Anybody else? Okay. Next, we'll have the gaming percentage fee tax forecast from the governor or the fiscal analysis division.
Thank you, Madam Chair. For the record, Russell Ginnan with the Fiscal Analysis Division. And I may be having some technical difficulties here, but I'll see if I'm not. Okay, it looks like it might display on, hey, there it goes. But this is in the Fiscal Analysis Division's packet, which is the big packet outside the Economic Forums meeting packet. And I just wanted to quickly go through some slides to address the chair's request for what the outlook is that's lying behind the various revenue forecasts that were prepared by staff from the Fiscal Analysis Division that will be presented to you. So the starting point for us is that we look at the Moody's forecast, the consensus, as well as some of the other scenarios. But then we sit down and do our own forecast. And so what I have here for you is just it begins on page 2 of the fiscal packet. This is the total employment. And so we actually model this by looking at the different major sectors. So you can see that we're slightly higher. So Moody's has a little bit of a slower growth, but then by the end of the fiscal or the forecast horizon, we're pretty much comparable total employment forecast. Then with regards to the average wage per employee, we have it, sorry, let me get the cheat sheet here. Increasing approximately 2.5% to then 3% a year over the forecast horizon. And what we need to keep in mind is that based on Moody's baseline forecast, that they have the inflation as measured by the Consumer Price Index increasing by 6.3% on a fiscal year 2023, and then about 2.6% in FY 2024, and 2.2%, which is what I think we expect, that the Fed's the Federal Reserve can successfully engineer this soft landing, and they'll be raising rates and then start to lower them again next year, and then inflation will come back down in the 2 to 3% range. So thus, we have our average wage per employee growing not quite as fast as Moody's. And so again, 2.5% in FY 2023. So in real purchasing power, the average wage per employee gets sort of degraded. And then the average wage per employee grows around 3% in FY 2024 and FY 25. So then if we look at total wages, not surprisingly, Moody's is a little bit stronger than what fiscal is thinking because we have comparable employment growth, but not as much growth in wage per employee. But so that's the look at the wages that are for our forecast horizon. And then looking at the non-wage component, because we try and get to a total personal income and use that as one of the variables in our sales tax forecast, as well as some of the other variables, revenue sources. And so the non-wage component, the biggest component of this is dividends, interest, and rent. And so you can see we're stronger than the Moody's outlook in their baseline for Nevada because, the feds are raising interest rates. So in the near term here, the interest earnings, especially off the retirees and the retirees that are coming to the state. And then also the other component of non-wage is transfer payments. And one of the components is thankfully the UI and the other components of transfer payments, the sort of distortion is now out of them from the federal stimulus payments. So you can get back to looking at more the traditional, you have Medicaid and Medicare in there, and with the state doing the Medicaid expansion, we've seen that grow stronger here. And then also you have Social Security benefits. And as you're probably aware, that the IRS did off their calculations in the feds that it's 8.7% increase in Social Security benefits effective January. And so we built that in when we were looking at the Social Security as part of our transfer payments. And in thinking most likely inflation will subside, but probably the Social Security increases for the next 2 cycles will be larger than what we've seen due to inflation staying up a little bit to where it was pre the inflationary session that we're seeing here. So thus you can see for us that our wages and non-wage, we're one of the states that where non-wage stays above wage income. You can see it's been above it. Part of that was the expansion of Medicaid as well as, again, dividends, interest, and rent. And then you can see the stimulus effect, but we have it continuing to stay above over the forecast horizon. It seems bothersome at first, but not necessarily when again, some of the factors I said about what's driving dividends, interest, and rent when with the state's retirees and people moving here. And then you can see here's on chart 6A, and that this is the total personal income forecast between Moody's and the fiscal division. So we end up canceling out between wages and non-wages to basically end up with the same personal income. And I guess that's another way of demonstrating to the body that, there's more than one way to forecast something by different people and maybe end up standing in comparable places once everybody's done turning the dials. And so then here's our construction employment. We just think construction, that there's this inflection point that it'll start increasing at a decreasing rate, but we are lower than Moody's with regards to construction employment. We realize interest rates will put a curb on some projects, but the projects that are going on in finance will continue to go on. And those that are in the slot. So could it be a little weaker? That's one of the things we're going to have to examine when we go back and think about this, to bring back for the December meeting. So chart 11A, which is on page 22 of the packet, I just wanted to show you this is our visitor forecast. And clearly this has become, it's always difficult as a thing to forecast. It's a little more difficult just because look at the chart, right? Where we were, then the pandemic's distortion, but we have it continuing to come back. And so I think as a prelude to the getting into the gaming, Mr. Lawton did a very good job of all the things that are out there that a forecaster needs to be thinking about, not just for gaming percentage fees, but for pretty much every revenue source, right? Which is, the gaming industry is demonstrated, I think, that they're very adept at using their facilities to get people in there. So it's not just Adele, it's not just Garth Brooks. That there are artists that want to come to Vegas and perform, and the industry will line up, whether it's at a casino's entertainment facility or at Allegiant Stadium, right, with Taylor Swift now coming. They'll figure out how to get artists to come. It's hard for us as forecasters to know when and where. Then also, as was stated, you have the Sweet 16 and the Final 8 games for March Madness. March Madness, you can see that in the numbers when you look at March without having Sweet 16 and Final 8 games. I think that's going to be a pretty good event for the state. Then you have F1 and Fontainebleau opening. Again, I think we can look at those and go, wow, that's a day or it's a weekend. It's not. They're building a facility down there to host the event. There'll be other stuff going on that'll generate economic activity. And then people will come in to set up for the race. Those are people that will bring economic activity. Similarly with the Super Bowl, there's a tendency to sometimes think about it being, well, it's a weekend, it's a game. No. When you go look at the Super Bowl in other places, it begins approximately 2 weeks before the event, with the people coming in, all of the sports people and the teams can come in and their people. Well, that won't be maybe the same order of magnitude as the people coming for the game, but you're bringing economic activity to the state for those types of events. So that's one of the things as we're trying to think through it, is to not get so myopic to think about it being a day or a weekend event. And so that's clearly, I think, makes 23 got some stuff going on. FY24 clearly has 2 major events in it, as well as they'll continue to probably figure out how to bring artists and residencies. And then there was a statement in the paper by Mr. Hill with the LVCVA about, hey, and I don't think the F1 builds a $500 million facility without possibly the expectation that maybe F1 is an annual event. But as a forecaster, it's hard to put that online in FY25 again without it being more definitive when we're sitting here trying to forecast revenues that the state will use to build budgets. So that's sort of the outlook or the economic information that we're looking at. So then turning to gaming, which begins on page 28 of the fiscals packet, and then you look at the line charts that are provided. Clearly, the fiscal analysis division is higher and appears to be the more optimistic entity with regards to. So I will just preface, when you look at the gaming charts that we do, they've been perplexing me for some time. When you go look at the coin in per unit and the drop per unit. So when I started this forecast exercise, it was my expectation that I would be walking things back, that there had to be some softening in that per unit, and even possibly the hold percentages on the slot side. But then as I start to look at the numbers and what I just talked about, the events, the big events, the other events that they'll have to bring people, I don't know if it's cold feet or not, but it's just like, well, what is there to really have me walk back? Because we're not gonna bring back the devices that we had. So that in terms of the pre-pandemic, in my view. So that's the denominator that per unit is going to stay up. And if they keep bringing visitors, then why should it really fall back? And then on the hold side, that one to me, right, the win percent from the industry's point of view and thus the state's point of view as a tax attached to the win, that's the price of this. And I'm trying to get more used to quit using slot machine, because having been around this for almost 30 years, they're not slot machines. They're electronic gaming devices, right? So they're much different than when those that want to think slot machines. And I believe the manufacturers in that, they're good at creating products that people want to play. And the industry's good at getting them out there. And then they'll create machines that most likely will have a slightly higher hold, or they'll be able to maintain the hold. Because these electronic gaming devices are much different type of gaming product than the old slot machines. And so they can create devices that people want to play and possibly continue to have the hold go up a little bit, because that's the manufacturer probably needs that, but also the industry needs that. Because without that, then your win gets degraded in inflation adjusted basis. So that's when I got to, okay, I didn't back things off. That's where I thought I would be, and I didn't. So on table 1B, and I apologize, yesterday looking through the stuff, in the taxable gaming revenue in the first 4 months, you'll see that it's equal to total win, and thus the ratio TGR to win's 100%. We wish, but it's, but I fixed the error. It won't be there in December, but it is now. Mr. Lawton was nice enough to give us where we are year to date. So when I look at my forecast, and I look at Clark County, Washoe, and rest of the state, I model those 3 areas. But then I don't bring all that to you because there's enough information. When I look at this forecast and get done, and you have a chance to put it away and then come back after sleeping on it, I'm sort of concerned, is the slot win a little too strong here in FY23 when they look at what I have to grow down there at the bottom in the last 8 months to hit the forecast? But am I a little too weak on games? But then I go look at the 3.1% that's needed, which is slightly less than the 3.8 that were up through the first 4 months. I guess my nervousness went away. Is this too optimistic? So then you can see what has to happen for the other components. And then, so for me, when I go look at, you can see I have a slightly higher ratio TGR to win for FY23. But looking at where it is through the first 4 months, and the nice thing is when Mr. Lawton releases the numbers in a week or so, or a couple weeks, that's five months of the 12 months of the fiscal year. Almost half of the fiscal year we'll have available to us to analyze. Okay, then forecasters will go maybe tweak their assumptions. But and then I have it walking back the ratio to around 96.7 and then coming back a little. I just think at 24 with the F1 and the stadium, there'll be a little bit more credit play possibly in that period. And thus maybe the TGR steps back just a little bit. But with the slots still maintaining the share of the market, there's just generally less credit in my view with that. So that's what's helped keep the TGR to win up. With slots being a higher percentage of the market. What you can see also is that I have the effective tax rate in FY23 coming up from the 6.59. You can see it's at 6.34 now, year to date. But I'll tell you, as a forecaster, one of the things that's perplexing me and I'm struggling with in terms of understanding and then making the forecast assumption is, so look at FY 2022, the average tax rate, and this is the average tax TGR, collections from TGR, removing the EFA from the distortion. So it was 6.59 versus 6.63 in FY 2019, right? I'm going to get rid of the 2020 and 2021 due to the pandemic distortions. But the taxable gaming revenue went from 11.4 billion in FY 2019 to 14.1. That's $2.7 billion. And remember, the tax rates are 3.5% on anything up to 50,000, 4.5% on the next 84,000, and 6.75 on anything over 134. The 134 is pretty much de minimis on a monthly basis. So you push $3.7 billion more in TGR through the top bracket, but the average effective tax rate went down, not up. So that's statistically perplexing to me. So I'm going to bank on, I believe it's got to come back up if we're going to continue to push. And in my forecast, I'm getting up now in the 15.1 and the $15.7 billion in TGR. If you're pushing that through the 6.75% tax bracket, I'm comfortable with the average effective tax rate having to come back up. And one could conjecture, if you do some of the math, could it be low? But I didn't want to get too optimistic on that, given that I've gone and looked at it monthly, I've looked at it quarterly to try and figure out what went on in 22 compared to 2019. And I just can't figure it out, other than the numbers are what the numbers are. So with that, Madam Chair, members of the forum, I think that's more the comments that I wanted to make, because Mr. Lawton, again, laid out everything. And I just look at this and go, I think 24 should be pretty good. And you can say, so then to get to sort of Mr. Zahn's question, the negative side, yeah, if there's a recession, clearly that will walk us back a little bit because some of those visitors won't come. But I believe for some of the things that, especially the F1 and the Super Bowl, that stuff's going to be relatively inelastic to a recession. Why? Look at what the ticket prices are. Look at what the room rates are. If you're going to come spend that money, yeah, the recession probably won't hurt you too badly compared to some of the other more marginal people. So will there be marginal effects? Yes. But for some of those things that are planned, I think it won't be as good an event, but it'll still be a fairly good event. But I have to be cautious to go, hey, 2 big events don't 12 months make for a fiscal year. And so then you can, to me though, I just think maybe 25 is too strong. But without a recession, I believe there will be special things happening in Vegas. And so with that, Madam Chair, I can attempt to answer any questions that the members may have.
Thank you, Mr. Ginden. Any questions?
I don't really have a question, but Russ, you've pretty well convinced me between all the presentations that all of you can use a great amount of logic and come up with very different conclusions. I think that sort of tells us something about the situation we're in right now throughout the entire country and the world, I suppose, is that, you know, the very best logic we can have and everything, we're still in such a period of uncertainty that we really don't know. That's the difficulty we face.
I would just comment, Mr. Levitt, that as forecasters, Moody's has the ability and the facilities to do what they do, is do baselines and to do alternate. For some of us other forecasters, it's harder to make the call on a recession in terms of when it's going to occur, how deep it is, and what the recovery is, unless it's, right? Unless you're looking in the side view or rearview mirrors and somebody's told you there's a recession. But to sit here, so we can be cautious and think about, hey, take in mind that there could be a slowdown or there could be negatives. But for me, as a forecaster, I've never forecast a recession in my life till we're in a recession, right? Because it's just hard doing what we do. So
Linda Rosenthal, for the record, if I could just go back, Mr. Lawton, and ask you a quick question on the statistics you quoted or the survey results from that tourism survey. What's the context of that survey? Is it just visitors to Las Vegas? Is it, because the percentages obviously were interesting, but is it a broad-based type of visitor, or is it, you know, we're talking about potentially higher wealth people coming in for some of these events, and so I'm trying to correlate the results of the survey to who we might actually see visiting the state during that time period.
For the record, Mike Lawton, Senior Economic Analyst with the Nevada Gaming Control Board. My understanding, this was a broad-based survey. This wasn't a survey specific to Las Vegas, or it was just a broad-based, market survey.
Thank you.
That they used for some of their modeling.
So those results may not be as directly correlated then with the expectation for what type of visitor comes in these next few years with these big events and what impact that might have on the economy and the tax.
Correct, and I think when I saw these, it just kind of, and I saw these after my models were done, but it kind of made me look and you know, you always have forecast anxiety, forecast doubt. And when I was like, well, okay, that kind of, you know, I'm not necessarily forecasting a recession. I didn't say recession one time in my forecast. I'm saying a pullback in leisure spending. You know, how they define a recession that's way beyond what I do. I have data, I have research, and that's what my research tells me is that, you know, we have resorts that are modeling for flat to low single-digit growth or flat to low single-digit declines. So if that's what they're modeling, that's what I'm going to model.
Off a very high base.
Yeah, I mean, we're still at great numbers. That's why I said it's an optimistic, pessimistic forecast. These numbers are nothing to be like, oh, this is terrible. We're doing $13 billion in win. I don't have 1 month in my model that doesn't do $1 billion in gaming win. And it scares me, but it's really difficult to bring it down much further. So.
Yeah, just one question, I guess, for all of you. We talked about 3 big events, F1, Super Bowl, March Madness, those events. F1, I completely get that's a new event to the city. Super Bowl, however, and March Madness have always been strong events just in general, right? We always see a strong consumer coming in. So how are you thinking about, those events have already been here. I'm assuming you're thinking about more discretionary income coming in, higher net worth individuals, but those are events that have already been strong. So how are you thinking about those as you're forecasting them being here on the ground?
Well, for the record, Mike Lawton, Nevada Gaming Control Board, March is always a monster month in Vegas because of March Madness, but we've never had tournament games held in Las Vegas. This is a first. So I think that's where you're like, okay, yeah, I get it. March is already strong, but wait, now we're going to have these games actually in the city. So I think that's why it kind of brings me a little bit more excitement than it would just it's March Madness, because yeah, March Madness is year over year, but this is March Madness year over year with Elite Eight and Sweet 16, which those are two big weekends, right? So, and then your other point was Super Bowl. I mean, I've heard studies before where the economic impact in Las Vegas without the Super Bowl has already been bigger than the cities with the Super Bowl, and now we're having the Super Bowl. So I just think it adds a whole nother level of economic activity and growth for, like Russ said, it's not just Sunday. It's a period building up to that big event.
Jason, for the record, Jason Gortari, Executive Branch Economist, Governor's Finance Office. I agree much with what Mr. Lawton said. In addition to the Super Bowl comment that he made, I believe more people visit Las Vegas for the Super Bowl than where the Super Bowl is actually being hosted. So for this go around, I think we'll have the additional 65,000 attendees on top of the people that are excited just to be in the Las Vegas environment to watch the Super Bowl at surrounding casinos or bars or in the tailgate environment.
Thank you. I don't have too much to add to our statement, but I think those types of things like actually having a weekend of Sweet 16 and Final 8, that just stacks on top. I mean, I have friends that they religiously come to Vegas for March Madness. Why? Because they can be in Vegas, sit in the sports books, watch the tournament games, and do the betting. And so now you stack the games there and you bring all the players and the fans and all that. I just think it'll be a pretty good event. Then with regards to the Super Bowl, just when you go look at what the estimated impact for some of those, and no offense to those locations, they're not Vegas. Right? I think you're going to have people drive in from Southern California, whether the Southern California team makes it or not, because it's a Super Bowl in Vegas. Maybe I'm over-exaggerating, but I just think. And I think the F1, from everything we're reading, I just think that's going to be a phenomenal event. And when I went online and looked at where the course actually is, how many of those hotel rooms that the casinos have, they're the stadium that you can be in your room and watch almost the whole race. I just think it's going to be a phenomenal event and probably will continue. And then, Mr. Crum, you had the question to the other members about, hey, with gaming expanding in other markets, if it's casino-style gaming, I think the state has long proven since the mid-'90s that that's not really a detriment to us. Why? Because I believe then, and I still believe now, that the expansion of gaming probably it causes some people to not make as many trips, but it now causes people to make trips. I call them latent gamers. They didn't know they were gamers until you brought gaming close to them, and they became a gamer, and they want to come to the Mecca. So they do. So that's the one thing. With regards to the sports wagering, I think that could have a little bit of a negative effect. But I also believe it could have somewhat of a positive effect. Why? Because people who maybe weren't sports wagers become sports wagers, and now they want to come to the sports books in the casinos for a weekend to watch whatever sport it is and make wagers. Maybe that's overly optimistic, but I just think that would be my view, that the sport wagering that has some negative potential as the other states expand into it, but it could also have some positive effects at the margin. Where's the net? Don't ask me to tell you whether it's net negative or net positive. But I just don't want to concentrate on the potential negative effect, I think, because there is some positive. And so hopefully that answers your question a little bit, Mr. Crum.
Yeah, Michael Crum. Yeah, that answers my question. Thank you. Just want to state, but for those big events, going back to March Madness and Super Bowl, we traditionally see high occupancy already. And so going back to my question, is it really that you're just assuming a consumer with a higher amount of discretionary income that'll just spend more? You're right, more people may come over, but at some point the city reaches capacity because of the occupancy rate. So I just really want to understand that piece. And I just don't want to over forecast what those events will do. F1, get it, it's new. Those other two, we already see traditionally high occupancy rates. So just want to understand that.
I would agree. And what I would add, Mr. Crum, is just, again, as an economist looking at, rarely as an economist do you get to see economic markets operate as quickly. But here would you go. So you ask yourself, look at what some of the room rates that are being reported for the F1 and probably going to be for the stadium, that the casino hotels, as well as some of the other facilities that aren't casino hotels but have rooms, that probably will still have a very good occupancy rate of those very high rates. If you didn't raise the rates, right, demand would be greater than the supply of rooms, which gets a little crazy given over the 100,000 some rooms that are down there. But that's, to me, when you just, as an economist, to be sitting here and watching live markets almost work in terms of when you have those types of big events and then see where room rates move and where some of the other stuff does. Why? Because they have to clear the market by raising prices in relation to the demand. And I think also one of the things that economists we have is there's Say's law, which supply creates its own demand. I think the gaming industry is one of those where clearly they're good at Say's law in terms of creating a product versus the good and the service. And people didn't realize maybe they demanded that, but they end up demanding it. And so that's just some of the views that I've carried. But again, I don't want to overstate that, yes, there are negative clouds sitting out there. And so, I don't know, Mr. Lawton just maybe have confused me more to go. He's going to probably tell us we'll have another record number, and then we're supposed to go possibly revise our forecast for your consideration in a couple of weeks. So.
Should be interesting in December. Okay. So I think with that, we are going to actually take about a 20-minute recess to let everybody take a little break. And so I don't know the exact time, but it looks like it's a little bit before noon. Let's actually plan to reconvene around 12:20. Okay, for the record, Linda Rosenthal. We are coming out of recess and are back in the live meeting. Continuing with agenda item number 6, we're on item B, the live entertainment tax. So we are going to have each presenter give their forecast both for gaming and non-gaming if applicable before moving to the next forecaster. So we'll start with Mr. Lawton from the Gaming Control Board. Gaming only, yes.
All right, again, for the record, Mike Lawton with the Nevada Gaming Control Board. I'm not going to give a economic outlook on this particular tax. I'll have my theory or hypothesis in the body, if that's okay. The casino live entertainment tax is based on a forecast of taxable casino entertainment activity. This forecast for taxable activity is based on an examination of historical growth patterns and, most importantly, through a review of entertainment offerings and discussions with industry representatives. The forecast also incorporates expected increases in taxable activity due to the opening of new properties, changes in entertainment venues at existing properties. I've said this many times before, the live entertainment tax is one of the most difficult taxes that the board has to forecast, as we do not receive any of the statistical detail that we do for our gaming-related taxes, and changes to entertainment offerings are challenging to predict, to say the least. On June 1st, 2021, all COVID-19 capacity limits were lifted, and starting in July, LET collections began to improve dramatically. FY22's total represents a vast improvement over FY21. However, LET collections remain below the peak levels recorded in FY16 and 17 under the current law. After last year's $92.1 million increase in FY23, the board is projecting LET to continue to increase, up 26.5% with $125.7 million in collections, which would be a new all-time total under the current law, which taxes admissions only at 9%. Fiscal year to date, where we stand, is a total of $28.7 million in collections. That's up 26.8% or $6 million over FY22 through September. The growth comparison for the remaining 9 months is an increase of 971.2%. For 24, the board is projecting $122.5 million in collections, which is a 2.5% decrease from fiscal year 23. And then in 25, we're forecasting $118.7 million in collections, which is a 3.1% decrease. Still well above any records that we had prior to the pandemic. Our models are built on the assumption that FY23 growth will be achieved by increased showroom occupancy as a result of improved business travel, lifting midweek business levels. LET sales have trailed gross gaming revenue growth over the past 19 months and have not peaked due to the lag in business travel compared to leisure travel. Midweek group convention business is a key component to LET recovery, and it's crucial for large production shows and headliners. These performances include multiple shows throughout the week and require large venues to be at maximum capacity in order to be profitable. Additional incremental growth this fiscal year is forecasted due to new programming at the Las Vegas Strip at multiple properties, including the Park MGM, Wynn, Venetian, Caesars, Adele, Awakenings, John Cougar Mellencamp, Garth Brooks, Maroon 5, Keith Urban, a new show at the Paris. And like I said, Garth Brooks was just announced this morning. We will probably have to come back to you in December, and the FY24 forecast, I imagine, will be increased. Moving into 24 and 25, LET will begin to see some very difficult comparisons due to known programming that we have coming online in FY23 versus unknown programming in the out years of the forecast period. It is anticipated that this could result in a gradual decline in collections due to a softening of the average ticket price charged in FY23, in addition to potential moderating in consumer spending. So very similar to gaming percentage fees, we anticipate perhaps a softening in consumer spending, along with difficult comps because of shows versus shows, what we know, what we don't know, and that's that's kind of our outlook as we move past 23, what we're calling the peak into 24 and 25. And with that, I can answer any questions that you might have.
Thank you, Mr. Lawton.
You're welcome.
Now we'll turn it over to Mr. Cartieri.
Thank you, Madam Chair. For the record, Jason Gortari, Executive Branch Economist, Governor's Finance Office. I'll first discuss the live entertainment tax gaming portion, referencing slide 8 of my presentation. Visitation is one of the main drivers for both gaming and non-gaming LET. My forecast assumes an increased visitation in the fourth quarter of calendar year 22 compared to the same period in 21. My forecast also assumes increased growth in the number of local residents who spend money on entertainment because of the tight labor market and growth in wages that we've seen recently. Furthermore, the expectation is that the overall trend in Las Vegas visitation continues to increase, which is expected to continue if people have disposable income. Fiscal year to date through September, this revenue source is up 21% or $7 million over the year to date amount collected last year. My forecast elevates in fiscal year 23 to $119.4 million and then steadily increases in fiscal year 24 and 25 to $122.8 million and $124.8 million respectively. Would you like me to continue on to the non-gaming? All right, now I'll discuss the LET non-gaming tax forecast, referencing slide 10 of my presentation. Non-gaming revenues tend to attract high revenue events. With the addition of T-Mobile Arena, Allegiant Stadium, and other large non-gaming event centers, Las Vegas continues to reinvent and claim its stake of the tourism capital of the world. Not only is Las Vegas an international brand, but it has the infrastructure to host over 300,000 tourists in a weekend. And I think that really sets us apart from other metro areas in the United States and internationally. As an example, in fiscal year 23, as Mr. Lawton alluded to earlier, we have a few notable events scheduled to take place in Las Vegas within the same month. There's a Taylor Swift concert, an Adele concert, the Sweet 16 and Elite 8 NCAA men's basketball games, and then in fiscal year 24, Las Vegas will host a Super Bowl. My forecast also assumes visitation will continue to increase over the forecast period, and Las Vegas will continue to land these large-scale events, especially with its expansion into several major pro sports leagues and having the ability to host championships for those leagues, both at the collegiate level and professional level. Fiscal year to date through September, this revenue source is up nearly 200% or $6 million over the year to date amount collected last year. My forecast elevates in fiscal year 23 to $52.4 million and then moderately increases in fiscal year 24 and 25 to $52.6 million and $53.5 million respectively. And that concludes my LET forecast. Thank you.
Thank you very much. Now we'll turn to Ms. Scott from the Department of Taxation.
Good afternoon. Thank you, Chair and forum members. For the record, my name is Erica Scott. I'm with the Nevada Department of Taxation, and I would kind of like to go over my working hypothesis, which feeds into all of my forecasting, mostly this non-gaming LET as well. So in putting together this forecast, as we discussed, it's been pretty difficult due to unprecedented events such as COVID, post-COVID recovery, rising transportation and gas costs, the ongoing war in Ukraine, inflation, the raising of interest rates, and so on and so forth. With all these factors in mind, the department's working hypothesis for this forecast is as follows. In general, there will be a slowing of consumer spending. The employment rates stay consistent and healthy. Inflation rates slow due to fiscal policy, and a slowing of the housing market due to the rising cost of mortgage rates. However, it's not necessarily assumed we find ourselves in a proper recession, but rather a slowing of the growth seen in the past 2 years. That softening of that growth is it's going to be something that we'll feel overall. However, with Nevada's, the pieces to this, to Nevada's particular economy, it'll feed into this LET forecast that I am about to go into. In the fiscal year 2023, it is expected that Nevada will see some slowing of the revenue growth at lower rates than what we experienced in 2022, but still steady consumer spending. In fiscal year 2022, revenues were up higher than expected because of post-COVID economic recovery. In addition, inflation we experienced last year was driving higher revenues, but we can estimate the slowing of the spending effects have not yet been felt. We are also assuming employment rates will continue steadily into the next fiscal year. So for fiscal year 2024, the assumption is that inflation rates will slow while Nevada continues to have sustained real economic growth due to entertainment and tourism projects being completed. And this, of course, I'm referencing some of the same projects we've been discussing. There's MSG Sphere, Formula One, Fontainebleau, and Super Bowl. Some of these recurring events are more of what I have my eye to for LET, which will begin in fiscal year 2024. In fiscal year 2025, we should continue to see real sustained growth in employment and spending. So these are the key assumptions before I begin that taxation is putting forth today. So I'll go to my LET slides. So this little chart is showing the historic change since 2016 with LET, and then my forecast figures that are in there. As we can see from this table, the historic revenues from the non-gaming LET has been fairly volatile in the past, even prior to COVID, due to varying size and timing of events in Nevada. For fiscal year 2023, we're coming off of the continued post-COVID resurgence of live events when LET revenues were up 946%. So I don't think any of us would assume we'd see those continued changes in growth. However, we expect to see the revenues continue to grow in this area, again, due not only to historic live events that we've always had, such as EDC, Burning Man, Life is Beautiful, all of those events, but the newly added venues that will continue to bring additional events to Nevada. And the next slide is, we can see the historic revenues from LET in this forecast graph. I did a model based on just historic figures. Obviously, it's showing the lower confidence, dropping that way down, but we know we're on this more, we don't know, we can confidently say we're most likely on an upward trajectory of this tax. We're utilizing the upper confidence in this forecast for the reasons that I've stated. So the new permanent event spaces and new recurring events planned are expected to drive LET revenues along the upward trajectory. And with that, I can pause for any questions that you may have.
For the record, Linda Rosenthal, sorry, that last comment you just made, so your forecast is the yellow line, or your forecast is now the upper bound orange line?
The forecast should be the upper bound line.
Okay.
Yes.
Just checking, because the yellow line says forecast, but did you revise that?
That label is from the general model that when it, yeah, I
Got
went
you.
with the figures for the upper bound.
Thank you for that clarification. Perfect. Okay, thank you very much. Then next, we'll turn to Mr. Thauer from the Fiscal Analysis Division to discuss both gaming and non-gaming LET.
Thank you, Chair Rosenthal. For the record, Christian Thauer, Fiscal Analysis Division, Legislative Council Bureau. Economic Forum members will find Fiscal's live entertainment tax forecast numbers either on this green sheet on page 3 or in the Fiscal Analysis Division forecast information package from page 45 on. And that is also what you see here on the monitors. Beginning with the gaming live entertainment tax, Fiscal's forecast for the gaming live entertainment tax is based taking into account various considerations and sources of information. For example, we research ongoing and scheduled shows and residencies advertised on websites and other publications of major Las Vegas Strip gaming venues. And Mr. Lorton has basically given a very comprehensive overview on that before the recess, so I'm not going to repeat any of that, but suffice it to say, from Santana, Aerosmith, ZZ Top, Maneskin, Tenacious D, Adele, John Fogerty, Garth Brooks, to a New Year's concert with the Killers, gaming live entertainment seems to be on and above fiscal year 2022 levels. For our forecast of the gaming live entertainment tax, we also took into account inflation, information forecast as provided by Moody's Analytics, as a potential price driver for tickets and accordingly tax revenues. We also took into account our visitor forecast projections, which foresee a gradual increase of visitors reaching pre-pandemic levels in fiscal year 2025. Finally, we also took into account the already by several speakers mentioned new events coming to Las Vegas, such as the Formula One race and the Super Bowl. We believe that these events will, in all likelihood, draw large crowds of visitors to Nevada, who will, as we believe, also wish to enjoy gaming live entertainment and so boost gaming live entertainment tax revenues. Against this background of information, we project the gaming part of the live entertainment tax to increase in fiscal year 2023 when compared with FY 2022 by 18% to $117,205,000. In fiscal year 2024, we project the gaming live entertainment tax to increase another 10.6% to $129,612,000. And in FY 2025, to increase by 4.7% to $135,640,000. And if I could, that is the last piece of information I would like to provide, chart 3 in the fiscal information forecast package, which you also see on the monitor. Maybe I can put it up so that, yeah. So what you see in this chart is the blue line is gaming live entertainment tax revenue dollars broken down by visitor. And the blue line is, so to say, the nominal dollar amount, the absolute dollar amount. The red line is, the red graph is representing gaming tax revenues per visitor on an inflation-adjusted basis. And what you see is that our forecast projects increasing gaming tax revenues, gaming live entertainment tax revenues, but in terms of inflation-adjusted dollars per visitor, our forecast projects that basically we reach pre-pandemic levels, right? So we do not forecast an increase in tax revenues per visitor, right? But visitor numbers will increase. Inflation is a driver, and that is part of what drives our forecast of the gaming live entertainment tax revenues up. I will now turn to the non-gaming part of the live entertainment tax, which we have here. Generally speaking, this revenue source is primarily driven by large one-off and special events. These include music or art festivals, such as Burning Man, the Electric Daisy Carnival, or Life is Beautiful. They also include large concerts in the T-Mobile or Allegiant stadiums. For example, Taylor Swift is scheduled to play the Allegiant Stadium in March of 2023. Big sports events are also part of this. as mentioned, the Formula One race, March Madness, basketball, or the Super Bowl. In particular, the Formula One race and the Super Bowl will, from what Fiscal has learned about these events, have an impact on non-gaming live and tax revenues in FY 2024. One interesting aspect in relation to the Super Bowl is that, pursuant to NRS 368A.200, the live entertainment tax does not apply to an athletic contest conducted by a professional team based in the state if the professional team based in the state is a participant in this contest. So in other words, if there was a professional sports team with a home in Nevada that were to participate in the Super Bowl, that would have an effect on the live entertainment tax in the sense that we wouldn't get any live entertainment tax from this. We took that into account and decided to split the anticipated live entertainment tax revenues that would derive from the Super Bowl into half, so that in either event, with or without participation of a Nevada-based team, our forecast will not be too far off from actual revenues. In view of these considerations, we project the non-gaming part of the live entertainment tax to increase in FY 2023 when compared with FY 2022 by 27.9% to $50,908,000. In FY 2024, we project the non-gaming live entertainment tax to increase by 33.9% to $68,163,000. And this takes into account the mentioned special events of the Formula One race and the Super Bowl. In FY 2025, without the Formula One and without the Super Bowl, we project the non-gaming part of the live entertainment tax to decrease by 15.4% to $57,699,000. And with that, I'd be happy to take any questions. Thank you.
For the record, Linda Rosenthal, if I could just ask the other forecasters their assumptions for the Super Bowl event, given the difference whether the Raiders were a participant or not. Mr. Lawton, did you assume any kind of tax benefit from the Super Bowl in '24?
No, not on the gaming LET. I did not.
And you would be, and then budget office.
For the record, Jason Gortari, executive branch economist. No, I did not either. I didn't make that assumption into my forecast.
Okay, great. And then, are there other events in town? I mean, I assume all the events you guys have stated are ones that are subject to the tax, but are there other events in towns that aren't subject to this tax that we should be aware of? I think in the past there was some kind of electric light show or something that didn't qualify, is that right? Don't know.
On the gaming side?
Well, just either side, just. That's okay, it doesn't sound like you've assumed anything anyway in any of the forecasts. I was just curious how a little more detail how that tax works, since there was definitely a legislative nuance to the professional sports team participating.
Yes, there are several exemptions in this chapter in the NRS to the live entertainment tax, both on the gaming and non-gaming side. And one of the pertinent ones is, of course, that professional sports teams that with a home in Nevada are currently, under current law, exempt from paying this tax. There are other exemptions that I believe relate to certain, I believe, high school sports. I would have to look that up and come back to the forum with the specific information on that. Thank you.
And then you mentioned in the law that you cited that it's professional sports teams. So thinking about March Madness and Elite Eight, nothing that would prevent ticket sales if UNLV, for instance, or Nevada were involved in any of those games that would limit the non-gaming tax?
Oh, it would. It would, absolutely. Indeed. Nothing would prevent the sale of tickets, but it would prevent the Department of Taxation to collect the tax.
Okay.
If a team of Nevada participates in these tournaments.
Even though they're not professional teams at that point, they're collegiate teams. That's
correct.
Okay.
That's my understanding.
Thank you. Great. Thank you all very much. think we're good on that. So we're going to move on to subsection C, which is the state 2% sales tax. So I believe we'll start with taxation. Ms. Scott, whenever you're ready.
Madam Chair, if I may, just on the LET, just for the members' edification, that it gets interesting with the professional sports exemption, and because they had the Shamrock Classic, right? I think that's what they called it at Allegiant, and it was BYU and Notre Dame, and so no Nevada team in there, so taxable. If Notre Dame or BYU would have played UNLV, under the law, it's out. And so then with regards to like the NCAA, again, probably as a fiscal person for the state of Nevada, I would hope that the NCAA doesn't put a Nevada team in the bracket that would end up in the Sweet 16 and Final 8 games in Las Vegas. Because, right, most likely then the college sports exemption for a home-based team would have some application to that event then. And then the last thing is just, as we keep in mind is the nuance, like T-Mobile, right, is on the non-gaming side, even though it's sitting there by gaming. It's sort of our understanding, conversations that we're having, that the Sphere, the MSG Sphere when it opens, will be like the T-Mobile. Even though it's there with a casino resort, it won't be construed to be under the licensed gaming establishment for the purposes of reporting. It'll be under the non-gaming. So those are just some of the nuances when we're having to do gaming and non-gaming to keep track of who's where as the events. And then you can see the forecast move differently because of these new facilities coming on and where we have to book the revenue.
Thank you, Mr. Ginden.
All right, Erica Scott for the record again, Department of Taxation. For my sales and use tax general fund revenues, we're keeping the same assumptions I went over earlier. Going to see some slowing in the growth, but not a distinct recession, if you will. So what I took into account was the taxable sales components of the different industries. And when putting together this forecast, we took a look at all the different revenues coming in from these different areas. And then I kind of zoomed out as far as historic revenues for the 2% sales tax. If you want to go to the next slide. So this is on slide 8. It shows the historic revenues under this tax type, just the 2% for the general fund. And we can see that distinct dip in 2020 from COVID and the post-COVID recovery with an almost overcorrection in that area. And then, of course, coming off of the volatile past few years, it's very difficult to confidently forecast for this. However, widening that scope to capture the last, recession time period and then the COVID time period, we can get a better picture of the long-term historic picture of the revenues. And then in slide 9, when I initially went to do this forecast, utilizing the Moody's model, we're looking at, 7.7% 7.76% growth in FY23, 6.68% in FY24, and 10.76% in FY25. However, utilizing the straight historic trends, it's much lower and shows a drop, almost a drop off. So for my forecast, I opted to kind of average the two, kind of marry those two, and tamp down the exponential growth on the other model to kind of bring it down with that assumption that taxation's saying the consumer spending is going to slow some. But so essentially, this should be, in my opinion, a happy medium to estimate some of these revenues. And so on slide 10, that will show us the figures that taxation is putting forth. So in FY23, we're showing a growth rate of 7.13%, 4.56% in FY24, and 6.54% in FY25. The 21% growth that we saw in FY22 is not anticipated to be relived in FY23, 24, or 25. So it's assumed this was an effect of inflation driving the higher revenues, so for some of the same items that consumers were purchasing, they were just paying that higher price. So, and also capturing some increased in spending post-COVID that may have spilled into FY22. So the assumptions that consumers will likely slow their spending on recreation or any other additional spending other than household items, we're assuming it's going to slow down. And then in FY24, we see continued growth, but at a slower rate. And then into FY25, we'd expect to see that leveling out of sustained growth. And with that, I can answer any questions.
For the record, Linda Rosenthal. So just one quick question. The chart that you showed, I think it was slide 9, where you show Moody's compared to actuals, and then how you kind of, at least on the chart, it looks like you diverge. Oh, sorry. I was taking the green bar as your forecast. That's a historical trend forecast.
Yeah.
Never mind. Never mind. Thank you. No questions, I think.
Thank you.
So then we will move over, Mr. Katari from the Budget Office.
Thank you, Madam Chair. For the record, Jason Gortari, Executive Branch Economist, Governor's Finance Office. I used a regression model to forecast retail sales driven by variables such as visitation, employment, wages, and total gaming volume. I also used many of the same assumptions that I provided in my opening remarks. Turning to slide 12, taxable retail sales have increased over the year for the past 19 months. With inflation increasing to over 8%, an upward adjustment to goods has resulted in higher prices and therefore higher collections. Turning to slide 13, you can see the top 12 taxable retail sales revenue generating industries in Nevada. The dashed lines on the facet chart are the current taxable retail sales amounts as of August of 2022. The charts are ordered from the top ranked to the 12th ranked, so left being the highest, right being the lowest. These are also based on the 3-digit NAICS industries. It's important to note that almost all 12 taxable retail sales industries are elevated far past their pre-pandemic levels and continue on a positive trend, as you can see represented by the dashed line, which represents the most current month of data, which is August of 2022. Next, if you look at non-store retailers, which is 5th in line on the chart, from 2018 to 2020, non-store retailers have shot up from the 17th largest taxable sales source to the 5th, increasing by nearly $400 million over 4 years, and is trending on a vertical path as remote sellers increase their market share in the overall retail space. To provide you with some additional context, the U.S. Supreme Court ruled in South Dakota versus Wayfair in 2018 that states can require remote sellers to collect and remit sales or use tax on sales delivered to locations within their state, regardless of whether or not they have a physical location in the state. Consistent with the Wayfair decision, Nevada adopted regulations, or Assembly Bill 445 of the 2019 session, requiring remote sellers and marketplace facilitators to collect taxes on retail sales into Nevada. These sellers must exceed $100,000 in revenue or make or facilitate 200 separate retail transactions in order to be subject to the tax. Please turn to slide 14. With that in mind, I believe this revenue source has realized a new normal. I have my forecast steadily increasing throughout the forecast period, with collections coming in at $1.75 billion in fiscal year 23, $1.81 billion in fiscal year 24, and $1.9 billion in fiscal year 25. And with that, that concludes my 2% sales and use tax forecast. If there's any questions, I'd be happy to answer them.
Thank you very much. Seeing no questions, we'll turn it over to Mr. Ginden to go through the Fiscal Analysis Division's forecast.
Thank you, Madam Chair. For the record, Russell Ginden with the Fiscal Analysis Division. And so the sales tax portion of our forecast for the Fiscal Analysis Division in their packet begins on page 53. The table that shows the forecast on a fiscal year basis actually on page 54 is which I have up on the screen that's showing over here on my back right shoulder. If we can get it up on the other screen. And I don't think I have to go over, because when we went through gaming, you know what I'm thinking. And so taxable sales, the starting point is an equation that's modeling taxable sales per employee is a function of personal income, visitors, construction employment, new car registrations. And so instead of using like the variables that Moody's was using in their equation, we have the visitors trying to pick up the out-of-state stuff versus using the national personal recreational consumption expenditures that they do. And so what we found is that because of what's going on with the strong growth, the equation has a hard time picking up and explaining what's been going on for the last several quarters. But after that, it's when things normalize, the equation didn't do so bad. So that was our starting point of the forecast. And you can see when you look at either the tables or the line charts, all four forecasts are pretty much laying on top of each other for all practical purposes. And so I don't quite know what's going on here, that it won't display my stuff. So anyway, what I wanted to do is just try and go through a couple of the charts in terms of more to try and help the forum with regards to, you have four forecasts done four different ways, and they're all pretty much grouped in there pretty tight. So that doesn't, right, as the forum, you can go, well, are they all okay or are they all wrong as a forecast, since they're all in there. And so when I look at it, I'm not bothered by fiscal's forecast. It seems strong. And if you look at the chart on page 58 of the packet, you can see it's showing you the 2% tax collections. And so there's an inflection point in the forecast. And so, sorry, let me at least kill the other screens. I think I'm sort of figuring out what's going on here. It's not kicking out the other one when it's kicking in. So here's the sales tax collections. So there's an inflection point where, right, it starts increasing at a decreasing rate there compared to what it has been. But when you look at the quarterly forecast, like the last quarter grew approximately 10.3%, but inflation was 8.3%. So you still had 2% real growth in there. So when you go look at the fiscal year forecast, and I've got taxable sales growing about 6.9%, but inflation is projected to be 6.3%, which is really almost like not much real growth in taxable sales. So part of me is wondering, gosh, with inflation where it is, could it actually be stronger than what I have? But we know that under the baseline scenario for Moody's and where we've sort of got incorporated in ours is that the feds will raise interest rates here, but then be successful and then start to bring interest rates back in the second half of FY 2003. And thus inflation also will start to, right? We can't do 8% on 8%, I hope. We'll start doing 3 or 4 on 7 or 8, and then 2 on 4, hopefully. So that's, when I look at that in terms of just looking at what inflation's expected to do and what I have growing in taxable sales, it's hard to figure out how much real growth is occurring, because you have to believe there's real growth occurring in the state, irrespective of the high inflation. And when people come as their visitors, right, they're bringing a budget that's for hotel rooms, for gambling, for entertainment, for eating. Well, so right, we have taxes attaching to most of those things. So where do the people allocate their budgets? But when they eat, we get taxable sales off that. When they do their shopping on tangible personal property, we get sales tax. So there is sales tax clearly from those visitors. So hopefully, okay, we're up. So what the charts that I try and do to gut check the forecast is, so chart 5 that's on page 62 of the fiscal packet, which is up on the screen, this is taxable sales per total employee, non-farm establishment employee. So you can see how it's sort of running in the trend here pre-pandemic, and then it went down and then it's jumped way up here. Well, no surprise, because we had taxable sales much stronger than the employment. But then I have, well, it's still continuing fairly strong, but I don't know that that bothers me that much given our employment forecast in relation to our taxable sales forecast, because we have employment continue to grow, but we don't have full recovery of pre-pandemic levels of the leisure, gaming, and hospitality sector of employment. So thus the denominator isn't quite what it would be pre-pandemic. So then the ratio should stay up over the forecast horizon. And I don't think that's unreasonable to think that leisure, gaming, and hospitality will get back to what it was pre-pandemic. It will sometime over growth in the future, but not now. It's a little like construction from the Great Recession. Construction was up there way high, and then it settled back, and I think there's people that thought, well, gosh, we got to get those construction jobs back to where they were pre-Great Recession. That hasn't happened, nor I don't think a reasonable person would expect. Well, now I think the pandemic is, for the hospitality industry, they have a new production function, that they can produce the same good and service for their clients with less labor in their production function. So I don't think it's unreasonable to think that the leisure hospitality, that employment will not get back up right here quickly back to those pre-pandemic, because they have a new. So when I look at that ratio, it seems like, wow, it's strong. But I don't know that it is when you think about some of the underlying dynamics that are in our employment forecast scenario in relation to the taxable sales that then comes out of it. The next chart is the taxable sales per 1,000 of statewide personal income. So you can see it was sort of going down here pre-pandemic, and then really went down, and then obviously has come back up. And we have it running sort of flat, if not bumping up a little and then come back. Well, it goes up because you have those special events, F1 and the Super Bowl, that are going to generate taxable sales, not necessarily tied to Nevada personal income. I mean, there'll be some correlation, but right, you're bringing all these people who won't be generating personal income, they'll be bringing their personal income to Nevada, right? But the one thing that since Mr. Kotari mentioned it, I think why I look at this is it's not just about, hey, we're going to be getting visitors, we have the special events. But we have to keep in mind that being able to capture the online retail sales was a pretty important thing for Nevada's taxable sales base. So with the Wayfair decision, which we implemented through regulation, to catch online retailers, and then then we did the marketplace facilitator bill in the 2019 session that then required Amazon and those types of entities to actually collect the sales tax for the third-party retailers. I think most of that shows up in what's called the NAICS 454 non-store retailers, NAICS category reported by the Department of Taxation. If you go look at those charts that we put up, it's now floats between the 4th or 5th largest taxable sales category, ranked biggest. In FY22, I believe it came in at number 4. It's about 7% of the taxable sales. Before, it was down there around 11, 12 in terms of rank. So, right, it's clearly had effect. Well, that phenomena, people purchasing online, is not going away. But we have it in the sales tax base. So as inflation goes on and they're purchasing, we're now capturing that. So that's a good thing for taxable sales from the state's perspective of improving that tax base. And if you look at this chart, maybe you can see the hand there, where you can sort of see that these blips, this is the fourth quarter, this is Christmas, right? And Black Friday or whatever, Thursday, Tuesday, whatever days they're now doing. But you can see how it was going down also. But then it flattened here, Wayfair, that's 2018. Then it went up, Marketplace Facilitator. So, right, you can even see those types of things when you look at the data, that the degradation, I think some of this is probably due that people were purchasing online. We weren't getting it. But then we started to get it, and the easiest place to go look is your Christmas sales, because it's a big thing. And so thus, the pattern that we have here, I don't think it's bothersome. And then just looking at the taxable sales per Las Vegas visitor, there's two charts here, right, to show you what it actually looks like. And then I compress the scale so you can actually see something out here. So you can see this was gradually increasing pre-pandemic, and then it flattens out a little bit here in the forecast. So it's not even increasing like it was here, and this is probably, some of this was helped by it looks like it turns a little bit because of the online sales getting picked up, which visitors probably aren't coming here and ordering stuff online. So that's why this ratio, the numerator, should have done better than the denominator. But it's relatively flat in terms of compared to visitors. So I'm sort of like, that's one thing I'll have to think about when I'm reconsidering the forecast for December, because with the special events, should it stay sort of flat, or should it have a little bit of bump out here? You can see the kick up, but should it have a little bit of upslope in terms of the taxable sales per visitor due to those two special events, given the order of magnitude that they may have? And then here's just the statewide personal income per employee. And this is one of those there makes forecasters' life easier, because you could go to Office Depot and buy a ruler, I think, and lay on this one pre-pandemic. And now in our forecast you could, but you can see it's got a little bit more slope to it than historically. Again, why? Because we have stronger non-wage due to Social Security being stronger because of the inflation adjustment and dividends, interest, and rent. So it's sort of a little stronger slope than you saw pre-pandemic. And then here's just the visitors per employee. And so it's coming back up. And by the end of the forecast, because this thing was falling, but I think it should start to come up a little bit again because of the not recouping all the loss of the leisure, gaming, and hospitality. So the denominator's changing a little bit versus the visitors, so the ratio can come up and stay up, in my view. And so with that, Madam Chair, those are the points I wanted to try and make, is the metrics that we look at to try and gut check the forecast, to think that fiscals, I don't think it's unreasonable. And it's laying in there on top of the other four. So are any one of them unreasonable? And with that, I can answer any questions that the members may have.
Thank you, Mr. Ginden. I think we have any questions from the forum, so we'll move on to the insurance premium tax, and we'll go back and start with the Department of Taxation. Ms. Scott, whenever you're ready.
All right, Erica Scott, again, with Department of Taxation for the record. So this will be fairly brief. The insurance premium tax historically has a pretty consistent increase over time. I essentially just took the historic rates and on slide 13 put out this forecast with pretty consistent 5 to 7% growth. It's very consistent. So. And that's pretty much all I have for you on that tax type, if you have any questions for me.
Thank you. Then we'll go to the Budget Office, Mr. Katari.
Thank you, Madam Chair. For the record, Jason Gortari, Executive Branch Economist, Governor's Finance Office. Please refer to slide 16 for my insurance premium tax forecast. The insurance premium tax is a relatively stable revenue in the state, and it's not subject to as many fluctuations as some of the taxes that are more closely aligned with tourism, such as the gaming percentage fee or live entertainment tax. With that in mind, I estimated the IPT revenue with a regression model based on households, medical, CPI, and the 10-year Treasury rate. Those estimates come out of the Moody's forecast database. My forecast steadily increases throughout the forecast period, with collections coming in at $569 million in fiscal year 23, $612 million in fiscal year 24, and $657.9 million in fiscal year 25. And that concludes my insurance premium tax forecast. I'd be happy to answer any questions. Thank you.
Thank you. And then lastly, on this revenue source, we'll have a presentation by Mr. Nakamoto from the Fiscal Analysis Division.
Thank you, Madam Chair, members of the forum. Good afternoon. For the record, I am Michael Nakamoto, Chief Principal Deputy Fiscal Analyst with the Fiscal Analysis Division of the Legislative Counsel Bureau. The insurance premium tax forecast for the Fiscal Analysis Division begins on page 69 of the Fiscal Analysis Division packet. The forecast itself is on page 71. And this is, for the three returning members, a table that we have done before, but we've have a little bit more summary information to it, and I'll actually turn to that on the screen. It used to be that we reported a bunch of different categories, such as workers' compensation and industrial insurance, independently procured refunds, interest, things like that. Because that's not really the gist of the forecast, we decided to collapse those down into all other collections, which you can see actually we have as a negative to the forecast because predominantly the collections accounting in the all other collections are really adjustments to prior periods. So it ends up turning it negative. But basically what we're looking at are those quarter ending categories, the ones that make up around 95% of the collections for the tax. And as we look at this tax, this is one that is actually fairly stable. And I had page 72 up as showing annual collections from FY92 to the present. And you can see that the only place where the collections really went down was in the recession. We hit this peak around the Great Recession, and then it slid just a little bit from FY 2007 to FY 2008. Then it went down for a couple of years and stayed around this bottom, and then started coming back up. But one of the things that you'll notice when you got to around FY 2013, FY 2014, is that increase was far steeper than you had even before the recession. And those of you who were on the forum back then remember that we were talking about the Affordable Care Act, the Affordable Care Act, the Affordable Care Act. And okay, we are now getting close to a decade into the Affordable Care Act, and you can see the growth rates that have resulted from the insurance premium tax since the implementation of that. With the exception of that little divot that you see in FY 2020 because of the pandemic, this has been a largely stable revenue source, and it is, by all appearances, going to be that way. If you recall back to the presentations that were made by the insurance division and the Silver State Health Insurance Exchange at the last meeting in October, they were talking about the rate changes that were being approved for health insurance, which is about 40% of the insurance market. And so the exchange had a weighted average increase of 9.2%. The insurance division was talking about small group market rate increases of 7.1% and individual market rate increases of 9%. So when you have 4/10 of the market increasing by anywhere between 7 and 9%, it's going to be another one of those revenue sources that remains, I think, fairly stable and growing at a fairly stable rate. When going back to our forecast on page 71, one of the things that we're really interested in seeing is obviously this first quarter of collections that the Department of Taxation is going to be releasing toward the end of November. Because if you look at FY 2022, that quarter ending June 30th, that number of 143.2 million, that is a record collection. So you go back over the history of this, you don't see anything that is even close to that for this category. And so we want to see what this first quarter looks like. We have it pulling back a little bit from there, but if it continues on the pace that it was, and we see something closer to $143 million, then even the Fiscal Analysis Division forecast of 5.4% growth in this fiscal year is potentially too low. And with those increased rate those announced increases of between 7 and 9%, it could well be. So this is something that we're going to look at and keep in mind. But this is one where we're going to continue this steady growth of around between 5.5% and 6% throughout the forecast horizon, just because, as we've pointed out, regardless of the economic conditions, insurance is still something that people are likely to purchase, be it for their homes, their cars, obviously for their cars since it's a requirement in this state to carry insurance for themselves, and having things such as high subsidy payments through the ACA, through the Inflation Reduction Act that are going to carry through to the end of 2025, at least under current federal law. There is not a lot of things that we see that would cause people to suddenly stop buying insurance. People are still going to buy insurance. In fact, it takes something like a Great Recession and people losing their jobs and not having a lot of buffer behind that to actually stop with the purchase of insurance. So with that, Madam Chair, I would be glad to answer any questions. There's one thing that I would note on Table 8 at the top of page 2, and this is a regular thing that we go through. For the agency forecast for the insurance premium tax, you may have noticed that the forecast that Ms. Scott had on her presentation don't match what is on here. There is an additional about $21 million that is added to the forecast for the surplus lines portion of the insurance premium tax, which is collected and forecasted separately by the insurance division of the Department of Business and Industry. So what is on Table 8 is the sum of those two forecasts rather than just the Department of Taxation forecast. So again, I would be glad to answer any questions. Thank you.
Great, thank you all very much. The next revenue source is the modified business tax. So we have non-financial, financial, and mining. I honestly don't remember if we take, each presenter doing all three taxes or if we want to go one by one. Is there a recollection from any of you or any suggestion for how to do that?
Madam Chair, I believe the practice was to do them all together. Okay. So to have the Department of Taxation do all three of theirs and then budget and then fiscal go last on that.
Great, thank you very much. So we'll start again back with the Department of Taxation and Ms. Scott.
Thank you, Chair. Erica Scott for the record, Department of Taxation. So with the modified business tax forecast, we can go to slide 15. Starting with the general business. So the historic rates for the general business of modified business tax, these revenues, we saw, generally that dip from COVID, of course, and then the upward trajectory again. Because of the healthy employment rates that we have been seeing, it's estimated that it's going to flatten out a bit. And then, of course, we have the modified business tax rate reduction coming up in FY24. So that's going to be factored in as well. We see on slide 16, so that's basically the general business funds. And then the financial institutions modified business tax, we see some growth in that industry as far as the upward trajectory of wages coming from that type of tax. And then we expect that growth to be sustained again in FY23, 24, and 25. However, the dollars collected may be seeing a dip due to the rate reduction in FY24. And on slide 17, we see the mining modified business tax, which we see a little bit of volatility here. Basically, I'm seeing perhaps due to some employment and shortages in the industry, also the seasonality and of mining on that chart there. And then on slide 18, I have my actual forecasted figures for the modified business tax broken up into, it has the total of the modified business tax, seeing that a slight leveling off in FY23, then the dip in FY24, and essentially I'm forecasting that there's going to be some resurgence in the FY25, but because of the reduced rate, we're not going to be seeing as much of the growth in the revenue source, even if wages are up for the reported wages for modified business tax. So roughly the estimated rate reduction in my forecast is roughly a $237 million difference if we were to stay at the same rate instead of reducing it in FY24, but we know that that's not the case. So we still estimate revenues to be up overall in FY25 due to sustained healthy employment rates from the Department of Taxation. And with that, I'll be happy to answer any questions you may have.
Linda Rosenthal for the record. So just curious on the mining, if you look at the charts that show the comparison amongst forecasters, I think the other two forecasters are showing growth and you're actually forecasting a decline. I know you said seasonality, and if you could just explain what might be driving that difference.
So with the historic trends, I think it's putting a lot more weight on historic trends in that industry rather than actual recent growth in that industry. If I may, I would enjoy to have some more time with this model and develop it a bit more.
Yeah, no worries at all. I just didn't know if there was an underlying reason or just, no problem. We'll look forward to hearing what you have to say in December.
Thank you.
Questions? Great, thank you. So now we'll move again to Mr. Kothari.
Thank you, Madam Chair. For the record, Jason Gortari, Executive Branch Economist, Governor's Finance Office. Please refer to slide 18 for my MBT non-financial forecast, or general business as it's titled on my slide. My outlook is based on the most up-to-date employment statistics. My forecast shows steadily increases employment throughout the forecast period. Nevada has currently surpassed its pre-pandemic job peak and continues to add jobs, with data as of September of 2022. Total non-farm is up 13,500 jobs, and the private sector is up 18,500 jobs from its pre-pandemic peak levels. The current employment level is 463,100. Also, the unemployment rate remains relatively low, historically speaking, at 4.4%. It's important to note that post-pandemic, a shift has taken place in Nevada's labor market. While the leisure and hospitality industry is down roughly 30,000 jobs from its pre-pandemic peak, manufacturing and transportation and warehousing are up 30,000 jobs collectively, with average weekly wages in both these industries more than doubling those of leisure and hospitality. Next, for MBT General Business Collection forecasts, slide 19 provides those. The red bars represent actual revenue forecast, and the green bars represent the forecast before the MBT rate buy down. Under the old rates, my estimates steadily increased throughout the forecast period, with $828.7 million in fiscal year 23, $877.6 million in fiscal year 24, and $929.4 million in fiscal year 25. However, after accounting for the MBT rate buy down, which is scheduled to occur in fiscal year 24. Fiscal year 24 and 25 amounts will be $745.1 million and $789.1 million, respectively, as seen in the red bars, or about $130 million less in fiscal year 24 and $140 million less in fiscal year 25. Next, my financial institutions MBT forecast, which starts with the financial employment outlook on slide 21. Employment data through September shows that financial industry employment is nearly 4,000 jobs above its pre-pandemic peak, and its average weekly wages are nearly $2,700 per week, the third highest in the state. While higher interest rates may impact employment in this industry, the expectation is the Fed will get a handle on inflation within the forecast period, and employment in this industry will continue to grow. Next, page 22 summarizes my MBT financial collection forecast. Under the old rates, my estimates moderately increased throughout the forecast period, coming in at $53.4 million in fiscal year 23, $55.6 million in fiscal year 24, and $57.8 million in fiscal year 25. However, after accounting for the MBT rate buy-down, the fiscal year 24 and 25 amounts will be roughly $46.6 million and $48.5 million, respectively, as seen in the red bars, or about $9 million less in each fiscal year. Finally, we have the modified business tax for mining. Please turn to slide 24. Employment in the mining sector tends to follow the trend of gold prices, which are currently hovering at an all-time high. The mining industry's average weekly wages are the highest in the state as well, near $2,700 per week, and employment is expected to remain stable in this industry over the forecast period, as many of the efficiencies have occurred already through the Newmont merger, and with new lithium companies adding their presence in the state. Page 25 summarizes my MBT mining collection forecasts. Under the old rate, my estimates moderately increased through the forecast period, with collections coming in at $21.8 million in fiscal year 23, $22.4 million in fiscal year 24, and $23.1 million in fiscal year 25. However, after accounting for the MBT rate buy-down, the fiscal year 24 and 25 amounts will be $18.8 million and $19.4 million, respectively, as shown in the red bars, or roughly $3 million less in each fiscal year. And with that, that concludes my MBT presentation. I'd be happy to answer any questions.
Thank you very much. And now we'll turn to Ms. Powers.
Good afternoon, Madam Chair and members of the Economic Forum. This is Susanna Powers, Deputy Fiscal Analyst with the Fiscal Analysis Division. I'd like to just point out quickly that each forecaster completed their projections without the rate reduction, and those forecasts are presented in Table 1 on page 65 of your packet. So it's the very last couple pages. It is easier to compare the individual forecast across the fiscal years when keeping the tax rate unchanged. And then the table 2 on page 66 makes the mathematical calculations needed to translate the forecasts to account for the impact of the reduced tax rates. So then those numbers on table 2 match the figures displayed either in your table 3 of your packet or the table 8, which is your green paper that was provided outside the packet. So I just wanted to make a quick note about that before I start with my own forecast. All right, so when I talk about non-financial, sometimes my colleagues here have referred them as general business. So just wanted to point that out, that it's the same thing. And I think I just lost a page here. Just a second. Okay, thank you. So go down. So the fiscal division's preliminary modified business tax MPT forecast starts on page 77 of the fiscal's forecast information packet. Taxation will be posting fiscal 2023 first quarter MPT collections later this month, and it may result in some changes to our final December forecast. The Fiscal Analysis Division forecasts the 3 components of the MPT separately as the wage basis and the level of healthcare deductions for the non-financial, financial, and mining portions of the tax, as they're different. Wage and salary disbursements are driven by employment as well as the average wage per employee assumptions. For non-financial, we forecast the major sectors subject to MPT separately, and then we roll them up to get to the total. Some items considered in our NFI MPT forecast assumptions are some of the inflationary pressures we're seeing in wages in fiscal 23. And then we also did consider many of the special events occurring in our state in fiscal 24. And then we expect things to normalize as we march towards fiscal 2025. As the inflation will slow down, we should expect to see the wage growth slow down as well. Our MPT NFI forecast will have a table on page 80 that I'll be talking from next. This displays our non-financial sector employment forecast. It is 3.9% growth in fiscal 23, 2.1% growth in fiscal 24, and 1.8% in fiscal 25. With regard to average annual wage per employee, we project 2.5% growth in fiscal 2023. Fiscal 24 growth rate is 3.3%, and 25 growth rate is 3.1%. Then the non-financial wages forecast is a function of non-financial employment and non-financial wage per employee forecast. We start with BEA data, Bureau of Economic Analysis data, and we adjust what we expect taxation to report for non-financial wages in relation to BEA reported wages. This information is displayed on Table 2B on page 81 of our packet, the fiscal analysis packet, in columns A through D. Fiscal 23 non-financial wage growth is 5.8%, and fiscal 24 growth is 5.5%, and fiscal 25 growth is 5%. Looking at the collections forecast for non-financial MPT in column K of Table 2B, and accounting for the tax rate reduction in fiscal 24 and 25 are as follows. Fiscal 23 collections are $789.3 million. Fiscal 24 collections are $705 million, and fiscal 25 collections are $739.6 million. Next is our financial institution MPT forecast. Let me go find that. All right. Some items considered in our financial modified business tax forecast. Some of the items we considered in our assumptions are, again, the inflation pressures on wages. We expect some negative impact of higher interest rate on interest rate sensitive areas of the financial sector, such as mortgage and other lending related employment. And then we expect the economy normalize. For MPT financial forecast, I'm starting on table 3A on page 85 of our packet. Financial sector employment is forecast at 2.1% growth in fiscal 23, a slight decline of 0.4% in fiscal 24, and 1.3% growth in fiscal 25. With regard to average annual wage per employee, we project 5.6% growth in fiscal 23. Fiscal 24 growth rate is 4%, and fiscal 25 growth rate is 3.6%. Then the next table is 3B. Total non-financial wages forecast is, again, a function of employment and wage per employee. And so this information is now displayed on table 3B on page 86 in columns A through D. Fiscal 23 total non-financial wage forecast growth is 7.9%. Fiscal 24 growth is 3.8%, and fiscal 25 growth is 4.9%. Then looking at the collections forecast for financial modified business tax is in column K, after accounting for the tax rate reduction in fiscal 24 and 25. Fiscal 23 collections are $49.6 million. Fiscal 24 collections are $43.2 million, and $45.3 million in fiscal 25. Our last forecast is the mining piece, and that will start in table 4A, and that will be page 89 of our packet. Some items considered in our mining modified business tax forecast assumptions are, again, inflation pressure on wages in the front end of the forecast period. Mining employment is really not fluctuating, as you heard earlier. This industry has found efficiencies from mergers, and for the time being, the forecast assumes somewhat of a steady state in this industry. For MPT mining forecast, please see this table 4A on page 89 on our packet for reference. Mining sector employment is forecast to decline by 1.1% in fiscal 23. That's just based on the most recent data that we have, and then stay steady. With regard to average annual wage per employee, we project 4.5% growth in fiscal 23. 2.6% growth in fiscal 24, and 2.4% growth in fiscal 25. Total mining wages, again, are also a function of employment and wage per employee forecasts. And if I can refer you to table 4B on page 90 of our packet in columns A through D, you will see the total mining wages forecast. Fiscal 23 growth rate is 3.5%, followed by 2.6% in fiscal 24, and finally 2.5% in fiscal 25. Looking at the collections forecast for mining modified business tax, you will find that amount in column K, and it is accounting for the tax rate reduction that will take place in fiscal 24 and 25. Fiscal 23 collections are $21.6 million, $18.6 million in 24, and $19.1 million in fiscal 25. That will conclude my presentation on modified business tax. If you have any questions, I'll be happy to answer.
Thank you, Ms. Powers. Next up is the real property transfer tax. And once again, we'll start with the Department of Taxation. Ms. Scott.
Madam Chair, before we move on to the real property transfer tax, for the record, Michael Nakamoto with the Fiscal Analysis Division. When Ms. Powers referred to the tables about the modified business tax forecast with and without the rate reduction, they are on pages 65 and 66 of the Economic Forum packet. Table 1 shows what the rates would be under the what is the current rate in FY23, but because the provisions of the law require the rate reduction to occur in FY24, we wanted to show you kind of what the economic activity was that was drawing the wages that would be driving the forecasts, and then the table 2 shows the reduction in the forecasts as a result of that rate reduction. So with that, I appreciate the chair's indulgence, and we can go on to the real property transfer tax. Thank you.
Thank you.
Okay, so for the real property transfer tax, this is Erica Scott, the economist with the Department of Taxation, again, for the record. So on the historic trends, again, the graph that I've got on the slide 20, historically, we can see the rise in revenues for this tax. Obviously, the last few years, growth in the housing market because of the low interest rates, historically low mortgage rates in fiscal year 21. A lot of people took advantage of that, selling lots of properties being sold and a lot of collections for this RPT tax. However, due to the increased interest rates, it's expected, of course, to flatten out. Although I don't foresee a negative slide in this tax, at least in my forecast, but definitely some slowing of the housing market. Of course, we're not likely to see the growth rates from FY22 again. And on slide 21, I've got my forecast figures there. So the peak of this growth is in FY22, and then of course moving down to just a 7% and 6% growth in the next 2 fiscal years is the forecast for the Department of Taxation. And with that, I can answer any questions that you may have.
For the record, Linda Rosenthal, just one question on your assumptions. So slowing of the market due to interest rates makes sense. I mean, obviously, housing prices are coming down, I think, pretty much across the state, and interest rates are higher, but you're still showing growth. So any items that are countering both the reduction in value and the additional hurdle of getting financing?
Just the estimate of still that demand for housing, that's estimated to be continuing, and people will still spend their money purchasing a home despite the higher interest rates, if it makes more sense to purchase a home than to continue to rent, or however you see that scenario. I think the demand for housing is still driving my forecast figures.
Thank you. Mr. Katari?
May I ask a question?
Yes, absolutely.
Vincent Zahn, for the record. How have these tax collections performed more recently, like over the past 6 months, for instance?
I will have to research that and get back to you. I don't know off the top of my head and don't have that in front of me today. Okay. But for sure, again, working with these models more for the next upcoming economic forum, definitely have more time to be with these models and figures as well.
Okay, thanks.
Thank you.
Thank you, Madam Chair. For the record, Jason Gortari, Executive Branch Economist, Governor's Finance Office. I'll now discuss the budget's real property transfer tax, starting on slide 27. Slide 27 provides some historical context of single-family home permits in Nevada, both on a calendar year and fiscal year basis. Housing starts in fiscal year 22 were the most we'd seen since 2007, as you can see on the bottom fiscal year chart. If you look at the top monthly chart at the start of calendar year 21, which is represented by the orange dot, builders seem to be set to work on digging us out of that hole we created from the 2008 to 2019 period. Recently, it appears that higher interest rates spooked builders a bit, as seen in the September 22 number, or the blue dot, but did not discourage them enough to drop to the 09 to 2012 levels. Next, on slide 28. Slide 28 provides a forecast for single-family housing permits in the state. Assuming the feds get a hold of inflation during the forecast period, housing permits should see a dip in 2023 and then pick up from where they left off in fiscal year 2022 for the remainder of the forecast period. Next, slide 29 provides Nevada's 12-month percent change in housing price index. The annotations represent point-to-point 16-month decelerations, with the last only showing an 8-month to current deceleration. Those annotations are represented by the black dashed lines and black numbers on the chart. While it's highly unlikely these periods are exactly analogous to the current period, I believe they serve as a useful reference when trying to form an opinion of the current rate of growth that we'll see moving forward. Well, I don't think we'll follow the major deceleration like we did in 05 to 2010, where there was 3 separate large decelerations. I think we could be somewhere in the middle of that one and what we realized in 2015. Next slide 30, my estimates for HPI growth roughly end with a 5% decrease by the end of the forecast period. Moving on to slide 31. Slide 31 provides some historical context on the U.S. average 30-year fixed mortgage rate. In October of 22, the 30-year fixed mortgage rates reached their highest rates in over 20 years. The last time the rate was higher was in March of 2002, when the rate was 7.18%. However, the rate has decreased slightly in November of 2022 to 6.95% from October's 7.08%. Next, slide 32 and 33 show a projection of existing home sales in Nevada on a calendar year and fiscal year basis. The forecasts expect existing home sales to decline in the first year of the forecast period due to the impact of the relatively high 30-year fixed mortgage rates, and then are expected to increase in the final 2 years with the expectation that the mortgage rates will continue to improve. With all that information in mind, real property transfer tax is a function of sales volume and price, driven largely by the residential real estate sector. Looking at slide 34, with the expectation that building will rebound, home prices won't bottom out like they did in 2008, and mortgage rates will decline over the forecast period. I forecasted collections to come in at $155.3 million in fiscal year 23, then pick up in fiscal year 24 and 25 to $165.9 million and $176.4 million, respectively. And with that, I'd be happy to entertain any questions if y'all have any. Thank you.
Thank you. Mr. Nakamoto?
Thank you, Madam Chair. For the record, Michael Nakamoto with the Fiscal Analysis Division of the Legislative Council Bureau. And I think I will start my presentation by actually answering Mr. Zahn's question about how the tax has been performing historically. And if you turn to page 104 of Fiscal's packet, which is actually the page that is up on the screen to my right, This is actual and forecast RPTT collections in thousands. So the last quarter for which the Department of Taxation has reported actual information is the second quarter of 2022, so it's the June, July, or the May, June, July period of this year, of just short of 45.9, almost $46 million. But you'll notice there that 2022 third quarter, that is as close to an actual number as we can get without actually being an actual number. And as I open up my presentation on this particular tax every time we have the forecast. The real property transfer tax is a statewide tax it's a tax that has statewide components and it has local components. And the way that it is actually collected is that the statewide portion, which is $1.30 per $500 of value of the property being transferred, this is actually collected at the county level. So the county recorder, when they are getting the request for a title transfer, the tax is paid at the time of the transfer. So they are the ones who are receiving the revenue. They keep a commission because they're entitled to under the law, and then they remit the collections on a monthly or a quarterly basis to the state controller. So we are actually able to go into the controller system and see the information on this tax as it's remitted. And so we have 5 of the 17 counties, Washoe, Elko, Lyon, Lander, and Eureka, who remit their collections on a monthly basis. Clark and the 11 other counties report it on a quarterly basis. And so when we were finalizing fiscal's forecast, we had 15 of the 17 counties for the first quarter. The only ones we were missing were Nye and Story. As of right now, because I checked over the weekend, 16 of the 17 had posted we had gotten Nye County. So the forecast that you're going to see for the Fiscal Analysis Division, at least for that first quarter, it's going to have a little bit of an adjustment to it depending on what Story County actually posts. But that 33.5 million thereabouts, or the minus 23.1%, that's pretty close to the actuals. So you can see, by and large, we've lost more than a third of the tax between the second quarter and the third quarter. And the other information that I can talk about here on that particular page, this total statewide residential property sales. And for this particular forecast, we went to the real estate site Redfin. And they're really good about having total residential sales. They break it out by co-ops, condos, single-family residences, and I just took the aggregate amount. And so this is not seasonally adjusted data, so that you can see that third quarter that is not highlighted there, that is their actual number. They're reporting their sales through September. So you can see that there has been a pretty significant drop-off. And we have talked about all of the different reasons why this is occurring, the increase in interest rates. Prices probably got to a level that were a little bit inflated. There are people talking about whether this is a bubble, a correction, a reset. I don't know if I want to go so far as saying that there's a bubble that is going to burst, but what became abundantly clear to a lot of people, especially through the pandemic in this work-at-home environment, is that people in a lot of places where it was not particularly affordable to buy a house found that as long as they were telecommuting and working from home, that home could be wherever they wanted to be. So a lot of tech money in California suddenly found its way elsewhere, including Reno and Las Vegas. So there have been analysts all over the place talking about, okay, what does this mean for housing prices going forward? And anytime you look at these lists of these markets that are going to correct by 15, 20% in terms of home values, Reno and Las Vegas show up at or near the top of these lists. So the RPTT forecast that we're presenting that is also on that sheet is reflecting that you have this general slowdown in sales. because of interest rates. We do not think, looking at Moody's forecasts of mortgage rates going into the end of this year, that they are still or going to fall as the Fed is causing, or they're increasing the federal funds rate again, and who knows how many times it might happen before they get this inflation thing under control. They may be increasing it again. We might be seeing interest rates above 7% and getting closer to 7.5% before all is said and done. And as long as that occurs, there is very little incentive for anybody to purchase a house right now. There was something that I was reading this morning that talked about just the volume of people even applying for a mortgage right now is down about 40% year to year. People are just not interested in buying a house. And as long as the interest rates stay high, as long as prices stay high, that's going to continue. The question then becomes, okay, when does all of this correct? And based on everything that I'm reading and seeing, okay, the Fed is going to get to a point where they're not going to be increasing rates anymore, and they will fall. The mortgage rate will fall, albeit at a more slow pace. But the sales and so the prices are going to have to fall for a little while before they actually start coming back, and we see that not coming back until the end of the forecast cycle. So if you look at Table 8, for example, you can see that we're forecasting a decline of 31.1% in FY23. So the next couple of quarters are going to be worse than this first quarter, which we are treating almost as an actual. And then in FY24, we have it going down another 14%. And then when you get to FY25, you get a little bit of recovery in the market. The one thing that I found really intriguing when I looked at Table 8 is when we put Table 8 together for this first meeting, you can see the Economic Forum's forecast, at least for the first year. And the forecast for this one, it's the May 4th forecast for the 2-year out, going back to calendar year 21. And the forecast that the Economic Forum selected for this revenue was the Fiscal Analysis Division's forecast. We are $116,000 below that forecast. We just did not see that there was going to be this giant growth in FY22. We missed that forecast by $52 million. So we saw a correction in the market. We just didn't see that it was going to be correcting from where it was at. So that is kind of the story that we're going to tell. I'm not sure that there's going to be a significant revision to this forecast that we would present to you in December unless we have somehow a better handle on what the market is going to look like in the next couple of years. And I don't know if that is likely. But with that, Madam Chair, I would be glad to answer any questions. Thank you.
Thank you, Mr. Nakamoto, for the forecast as well as the background on the history and what's causing the recent changes. Appreciate that. Okay, thank you very much. So then that brings us to the commerce tax. Mr. Ginden, who will be presenting this? Ms. Powers? Great.
For the record, Susanna Powers, Deputy Fiscal Analyst with Fiscal Analysis Division. Exhibits for this agenda item are in the Economic Forum packet on pages 67 through 70. So that is the hardcover packet. The process that is used for the commerce tax since it became a general fund revenue source is to develop a consensus forecast by taxation and the agency that administers the tax, GFO's Budget Office and Fiscal Division, that is then presented to the Economic Forum. This is the process that the Forum directed staff to use based on the discussions and actions at the June 2022 meeting and reaffirmed at the October meeting. The commerce tax is an annual tax on Nevada gross revenue on businesses, but it is paid on a fiscal year basis. The tax rate varies based on the type of industry the business is primarily engaged in. The first $4 million of gross revenue is exempt from the tax. The tax is due 45 days after the fiscal year ends on June 30th. We now have 7 years of history with this tax, and we know that we do not get the full amount at the end of fiscal year because the tax due date is so close to the official closing of the state fiscal year, which is the third Friday in September. So when the new fiscal year starts, we know now that approximately 10% of commerce tax collections will come from prior periods. We need to account for this tail because we know that revenue gets deposited then the following year. So on this table 1, on page 67, it summarizes how we account for this spillover. We start forecasting the commerce tax on a business activity basis. Therefore, fiscal 2022 is still an estimate, even though we have officially closed the book, but we have to start from here. So fiscal 22 is still an estimate as we are attempting to estimate how big of a tail we will have from last fiscal year that we need to account for. Since we do not have enough data points for more complex statistical methods, we have created an approach that attempts to connect the tax with relevant economic metrics in the state and form several scenarios for consideration. Table 3 on page 69 shows 5 years of history for selected economic indicators for the Nevada economy that can be kind of used as comparison. But I'm still on table 1. The first column applies the projected growth rates to commerce tax based on Moody's Analytics October 2022 baseline forecast for Nevada gross domestic product. Based on that scenario, commerce tax growth in fiscal 23 is 6.8%, 5.5% in fiscal 24, and 6.3% in fiscal 25. Then there are other growth scenarios or growth rate scenarios for consideration. And the last column is the consensus forecast that was prepared by Taxation, GFO's budget office, and the Fiscal Analysis Division. That's the gray column towards the right side. Fiscal 22 estimate and fiscal 23 forecast clearly have an inflation component. The two major events, the formula race in Las Vegas and the Super Bowl, are part of our fiscal 24 forecast, and then assuming more of an average year for fiscal 25. Our consensus forecast growth rates for the commerce tax on the business period basis are 7% for fiscal 23, 6.5% for fiscal 24, and 5.5% for fiscal 25. Then on table 2, on page 68, we take the business period commerce tax and we convert it into an accounting basis. That conversion produces different growth rates. This process allows us to estimate how the commerce tax will be deposited in the state's accounting system. The consensus forecast is in the last column in that gray in the color gray. In fiscal 23, we estimate the commerce tax will be hold on, just a second. I'm in the right table. In fiscal 23, we estimate the commerce tax will be $301.8 million, $321.6 million in fiscal 24, and $339.5 million in fiscal 25. So then the next page is table 3, and this just shows a 5-year history of selected economic indicators for the Nevada economy I mentioned earlier. And the last page has actually 2 sets of tables. And this is on page 70, and this is the last set of tables for this agenda item. This page has two sets of tables, Table 1 on the top and Table 2 on the bottom. Table 1 brings in the commerce tax business period with estimated tail and the associated commerce tax credits that can be taken against modified business tax. By law, businesses can take up to 50% of their commerce tax paid during the preceding year as credit against their modified business tax liability if they have payroll in the state. This is the reason why commerce tax credits are part of the forecast, as commerce tax paid determines how much of commerce tax credits may be taken against modified business tax. Historically, the amount of commerce tax credits have been slightly above 20% of the commerce tax. We estimate that this percentage will fall below 20 in a forecast period because we believe commerce tax will grow more than the taxable wages and because of shrinking modified business tax base due to the lower tax rate starting in fiscal 24. Table 2 then on this page translates commerce tax and the credits into an accounting period with those estimated tails and associated commerce tax credits that can be taken against modified business tax. Consensus estimate for the commerce tax credits is $50.6 million in fiscal 23, $54.5 million in fiscal 24, and $58.1 million in fiscal 25. This does conclude my presentation on this agenda item. Briefly, I just want to mention that we have posted the same commerce tax tables and pie charts that were part of your October 2022 meeting information, and those tables and charts can be found on today's Economic Forum's meeting page in Nellis, and they break down commerce tax information available by business category from fiscal 2016 to fiscal 2022 with any historical information we have. So thank you for the opportunity to present to you today. Are there any questions?
When they were putting together the provisions of the commerce tax, they must have had a really bad day. I can't believe when I look at that tax and how it's designed, that somebody would actually do this. But of course they did.
Thank you, all of the presenters today for all the work you do putting these forecasts together and helping us as a body come up with the best forecast we can for the state legislature and the governor. So that concludes the review and discussion of the major fund revenue sources. We'll now move to agenda item 7, which is the review and approval of the preliminary forecasts of the minor general fund revenues and tax credits for FY23, FY24, and FY25, which were approved by the Technical Advisory Committee on Future State Revenues at its November 4th, 2022 meeting. For this agenda item, I'll turn it over to Mr. Ginden.
Thank you, Madam Chair. For the record, Russell Ginden with the Fiscal Analysis Division, and I would just comment on Mr. Levitt's comment, which is that's what happens when you're trying to get 12 months of revenue in a fiscal year period. So being actively involved with the legislature and Governor Sandoval and working through that, it was trying to get 12 months of revenue in the first fiscal year. So the original proposal was for the tax to be quarterly, but right, you need time for people to put a tax in place and taxation administer it. So they were thinking maybe you could get 2 quarters in the first fiscal year. And so then as people started thinking, we realized, well, if you can attach it to the whole preceding fiscal year, if you have it due 45 days after the end of that fiscal year. So that was the sweet spot to have it 45 days after so that the taxpayer could file. But even though we're 45 days after the end of the fiscal year is really open till the 3rd Friday in September for us to be able to post revenue. So people knowing that, that's how the commerce tax came to be, Mr. Levitt, to be able to get that revenue. And thus you can see, eventually as we get more history, we might be able to move away from that. Because if you look at the differences as we're moving from business activity to accounting period, it's only a few million. But initially it was a bigger movement. But we knew once they were doing that during session approving, it was going to create interest for forecasters and for members of the Economic Forum to be able to try and handle this on a business activity versus accounting, because there can be the switch. Also, for accounting for the credits that can be taken against the MBT. So maybe I would concur with you that it did make life interesting for us, Mr. Leva.
You know, you could almost take the MBT and commerce tax and at this point in time and combine them into one with much less complex formula.
There are people listening, Mr. Levitt. With this agenda item, Madam Chair and members of the forum, I don't plan to go into intimate detail on these. There are a few points I want to make for the members as well as for the public that may be listening in terms of nuances. But these are the preliminary forecasts. So like the other ones, we'll be getting another month of revenue. And so this, we'll be looking at that to see if there needs to be any adjustments. Most likely the adjustments would be on the front end, not the back end of the forecast for most of these. But I will, as I go through, try and bring to your attention those that are like the discussion and the questioning that's been going on today. Some of these minor revenue sources are tied to events such as F1 and Super Bowl and visitors coming and those such. So the forecasters are trying to take that into account also. So with that, I just needed to point out that you have Table 5 in the packet on page 71, which takes some of the, what we call the selected ones. We call them the major minors internally, because it's easier for staff to give things names, and then we know what we're talking about. And then you have Table 6, which is actually the forecast approved by the Technical Advisory Committee at their November 4th meeting. And again, remember the process is that based on the form's direction to the TAC and taxation, GFO, and fiscal staff, we're all sort of working as staff to the TAC. So fiscal and budget, we work with the agencies, ask them for a forecast. Then we look at their forecast, we do our own, and then budget and fiscal get together and produce a consensus to bring forward to the TAC. The TAC, just like this body, is allowed to have presentations made, ask questions, and then either will make adjustments or not to the consensus. So what you have here is the consensus forecast that was brought forward by fiscal and budget staff to the TAC and was approved without modification. So as you look at the table, the first two under the mining tax category is the net proceeds of minerals tax and the mining gross revenue tax, gold and silver. So the net proceeds of mineral has been the existing tax, and so this is the portion of the tax that belongs to the state general fund under current law for FY23 only. Then beginning in FY24, based on 2021 legislation, it gets dedicated to the state education fund to become a K-12 funding source. Then the gold and silver excise tax was the new tax approved in the 2021 session. It's a tax on the gross revenue of those businesses engaged in extraction of gold and silver. It's a three-tiered tax with the first, $25 million, I think, exempt. And then there's two tax rates on the brackets above that. And so then, the first 20 million is exemption, and then the 150 million is taxed at 0.75%, and anything over 150 million is 1.1%, and this is on a 12-month calendar year basis, is the tax year. But under the law, that the proceeds from this tax went to the general fund through FY23 and then go to the state education fund beginning in FY24. That's why you see the forecast there only for 23 and then it's blank. So I just wanted to make sure probably anyone listening, if they go look at these tables and start making conclusions, they could be misled without understanding what's actually going on. Then the advanced license fee, you see there under the gaming section, that's the one that's when a new property comes online or there's a change in licenses such that it would trigger the advanced license fee. But that's after the first full month of business, the entity is required to pay 3 times that tax, and it exceeds the estimated fee adjustment process. So you can see that FY24 goes up because of Fontainebleau is a new property coming online. The Transportation Connection Excise Tax, which is GL 3073, second from the bottom, it's generally referred to by lots of people as the Uber and Lyft tax, but it's just not Uber and Lyft. It's the motor carriers in the business of transporting passengers, i.e. taxi cabs, limousines, those types of entities. This is the tax of 3% on the gross for net revenue of the charge for the patron using the services. And so I just want to point out, you can see it goes down in FY24. That's because the first $5 million of every biennium is required to be dedicated to the state highway fund. So you get the up-down pattern. So if you want to get an idea, add $5 million to the $33 million, and you can see it's expected to increase. There is consideration that was given to with the F1 and the Super Bowl, that there should be an increase in this tax with people coming and probably using the facilities of transportation connection entities such as Uber and Lyft, but then the taxi cabs are actually covered also, short-term car rental is covered under another tax. So this is the taxi cabs, Uber and Lyft type entities. Then on the third page, because the second page is blank, that's all modified business tax. You have under GL 3051, maybe about almost 2/3 of the way down the page. Just want to point out here that this is only 25% of the tax of the state portion of the governmental services tax, and this is tax that's based on the value of your vehicle when you register it each year. And so 25% is dedicated to state general fund, 75% of it is dedicated to the state highway fund, and that is the percentage for the forecast horizon. So because if you go look at the charts or tables of the history, you can see this one moves around because during the Great Recession as well as the pandemic, the legislature is making a decision to allocate some of the portion from the state highway fund back to the general fund to keep the general fund budget more intact in relation to the highway fund budget. But it's just, I wanted to point out that if you look at this, it's not that, if you go historically, we're not thinking it's going to go down. It's about a 2.5% increase a year looking at it historically. The thing is worth pointing out here for this tax, for the state's portion of the governmental services tax, the state's portion does not benefit from new vehicles. So when a new vehicle is purchased and first registered, it benefits the local and school district portion, or now the portion that's dedicated to state education fund. It isn't until the new car is registered in the second in succeeding years that it generates money for this portion of the GST. On the next page, under athletic commission fees, this is the one that attaches to unarmed combat. So one of the principal drivers here is UFC and those matches, as well as some of the other unarmed combat. Boxing would be included. Interestingly enough, while we were working on the forecast and including things and you may have seen the article that the Nevada Athletic Commission, based on requests by Dana White and the UFC, they've approved slap fighting now as an event. So we might have to contact the Athletic Commission to just see what if that may mean for us to take into consideration for any information available on when events might start occurring and whether or not needs to be any adjustment made to the forecast. Because that would be unarmed combat and should come under it. But we just saw the articles on that actually over the weekend and want to circle back with the Athletic Commission. So then in the fees and fines block, it's GL 3066, the short-term car lease. This is, as I mentioned, on short-term car rental companies. This component here now also includes what we call the peer-to-peer portion, based on a bill passed in the 2021 session. It's sometimes referred to as the Turo bill, but it requires those entities like Turo and other where private people can rent their privately owned vehicles on the peer-to-peer sharing platforms. And so the bill they're not deemed to be short-term car rental companies and thus covered like short-term rental companies, but they are required to have the tax collected on the value of the vehicle that the person's renting. And being, so it's 10% statewide is the rate, and then Clark and Washoe have an additional 2% that's dedicated and goes back to special purposes in those two counties. But so it's subsumed into this category, just so that I've identified that statutory change from the 21 session and the impact it would have. Then on the next page, one worth probably noting is the GL 3290 under interest income, the treasurer's section. You can see the larger amounts there because it was about $24.2 million actual in FY 2022, and then goes up to almost $60 million, and then $109 million, and back down to $89. The reason for this is, I think, fairly intuitive. The Federal Reserve is raising short-term interest rates, so thus the expected earnings that the treasurer can get from investing the state's portfolio, especially having to sometimes stay shorter because, right, this is the money that's coming in but also being used to cover the bills going out. But also in the near term here, we have not only on the interest rate side of this revenue source, but as was reported, we were $1 billion over the forecast for FY 2022. If you look at sort of where these forecasts are settling, the FY 23 forecast is going to be revised up probably substantially over the May 21 forecast. Whether it's another billion or not, we'll have to see in December. So that obviously adds additional revenue that the treasurer has available for investment. And right now, right, the appropriations for are not changing to meet the revenue coming in above. So it provides additional revenue there that can be invested. And it also, we have the federal stimulus money that we got. And so as that's being expensed, but under the federal guidance as well as our state law, interest that the treasurer can earn on the federal stimulus, the interest from that is required to be dedicated to the unrestricted state general fund. So those are the things, just when you go look at that, why it's higher but then walks back is, right, we'll be spending down the federal stimulus. We won't have $1 billion over the forecast in 24 and 25, and the short-term interest rates should be coming back down over the forecast horizon. So that's why you sort of see the hump in FY24 and then come back and settle back a little bit in FY25. And so with that, Madam Chair and members of the forum, or the comments I wanted to make, I just did want to point out when you go look at on Table 7 on page 83, which sort of takes, it's another way of showing the sort of major minors and then the tax credits. And I guess I should comment, the tax credits come from us working with the agencies responsible for administering those, principally taxation, the film office, and GOED. And we evaluate that. And so the forecasts you have here are the consensus forecasts that Fiscal and Budget brought forward to the Technical Advisory Committee and were approved by them. Probably the one worth noting the most is that the educational choice, or I'll go back to the table. The educational choice, or excuse me, the Nevada New Market Jobs Act ones are staying up over the forecast horizon, because if you go back and look, it fell off, but now it's coming back up into 24 million. Because that program was renewed for another $200 million worth of contributions that insurance companies can make, and then they can get credits equal to 58%. So 200 million times 58% is $116 million. And so the percentages are, I believe, 12%, 12%, 12%, 11%, and 11% over a 5-year period. So the 12% is worth approximately $24 million a year. So that's why you see that. And then the Affordable Housing Transferable Tax Credit Program, that's coming from the Housing Division applying us. They think that there'll be, it's a program that they were just getting up and going when the pandemic hit, so it sort of got backed off a little bit. But they have I believe one project approved that they've allocated $3 million, but they believe partnering the state's program with the federal stimulus money as well as the federal programs, that they'll be able to get more projects going for affordable housing and potentially get to the $10 million for each year. And so that seemed reasonable for us to put the maximum amount of liability on the sheets as a fiscal person. So sorry, I forgot to cover the tax credits. So then on the table 7, which is on page 83 of the Economic Forum's packet, it just shows you again sort of the major minors and tax credits. And if you look over there in the far right-hand column, the biennium difference, because this sort of tries to lay it out. So you can see that it's the current preliminary forecast for the minor general fund revenue sources and the tax credits is approximately $150 million below Well, that shouldn't be a surprise, because, right, you saw up above that we're taking two revenue sources, the net proceeds of minerals and the gold and silver, off of the sheets for 24 and 25. So if you would back those out, that effect, we would probably be up about 105 million. So that the miners are forecast increase, but once you have to account for the changes of taking revenue off the sheets, it actually is going down in the 23-25 biennium compared to the 21-23. And I just wanted to make that point. So when people look at that, you'd lead them to conclude that, wait, you're sitting here talking about all these things, and aren't some of these revenues tied to those things you're talking about occurring in 24? Well, they are projected to go up. They can't make up for the loss of moving the two revenue sources, which is worth, I think, about 150 million a year, or you're losing almost 300 million over the biennium from gold and silver and MPM. And with that, Madam Chair and members, those are the comments I wanted to make for this agenda item. And clearly, we'll be repeating the process. We're currently working towards the Technical Advisory Committee. Will have their next meeting on November 29th. And so we'll be working after this meeting to revisit things and have them meet, and then we'll bring potentially a revised set of forecasts back for consideration by this body on December 5th.
Thank you, Mr. Ginden. For the record, Linda Rosenthal. So just one comment, especially for the couple members of the forum who are new. We do instruct the Technical Advisory Committee to forecast these minor revenue sources for us. We also have the ability to reclassify things as a major revenue source. So if you see anything on this list, just some of the big change, right, is the treasurer line item. I don't know if that's something that interests you in terms of seeing a more formal forecast presented and having us approve that forecast or not, but just wanted to make you aware that there's flexibility in what we classify as the general fund revenues that we forecast and what we instruct the TAC to do for us. So, Mr. Ginden, just on that note, I don't know if there's interest, but if there were interest to change the classification of any of the revenue sources, could that be done at the December meeting? Would that be a May item? Would it be the next forecast cycle? What would the timing be in terms of changing the instruction to the TAC?
You could do it here today if the members of the body so chose to do and direct staff to do that. What I will offer for your consideration is somewhere in between the two endpoints, which is you can leave it a minor and have us work with the agency, take it to the TAC, discuss it there. But then when we bring it, we can make sure that if there is one, because if you switch it from a minor to a major, then we've got to redo the tables as to what's major and minor. So it's, again, not that we can't do that. It's just we're a little tighter turnaround between this meeting and the December 5th meeting than usual. So we could do that you leave it the way it is. But if you think, hey, we could have somebody from the treasurer's office here, and we just like we're doing, we could have the treasurer's office go through and present more information on the forecast for this, or the agency for any other ones, and or for fiscal and budget to provide their commentary. Sort of like I'm sort of doing it as the speaker for both GFO and fiscal as we got together and worked on this. So that might be the better logistical way, Madam Chair, is you don't move it, because then we'll have to redo the tables and all that. But you tell us if there is one you would, then we'll make sure we have that lined up under this agenda item to have more information presented by probably the agency that's responsible for it.
Thank you. So I guess just a general question to the forum members. Anybody have any particular interest in seeing any of the minors addressed or moved? Okay. Great, thank you. So I think that concludes agenda item 7. So agenda item 8, instructions to the Technical Advisory Committee on future state revenues concerning the general fund revenue forecasts. So again, Mr. Ginden.
Madam Chair, I think you may have just covered that agenda item. Seriously, I think that's what I would have asked you. Did you want to make any changes? So you already got there. And so as I've said, that we will basically after this meeting, there are a few of the agencies that we want to contact and have them, the bigger ones, think about. And then we want to see like for the short-term car rental, we'll get to see the first quarter. So we will get, it's not only getting one more month, it's getting the first piece of information on FY23 for the quarterly taxes. So we'll look at that, and like I said, we guess at that first quarter. So then we'll have to see if we have to fine-tune the takeoff point and whether that's just affecting FY23 or does it something that needs a path adjustment for 24 and 25. And we will be doing that. And so that's, given I think what you just went through, this agenda item is covered. We'll be meeting on the 29th to bring forward that. And what we do is we have generally some of the people, they might be in the Zoom meeting from some of the other agencies in case they are needed. So we'll just probably for some of those agencies tell them they get the Zoom invite, and we would appreciate, maybe they don't have to hang around the whole meeting, but we can let them know as we're approaching this agenda item for the minors. And we would appreciate them to be in the Zoom in case there is a question, and then we can call on them, Madam Chair, or actually physically be here as their schedule would permit. And so we will work for that.
Great, thank you. The next agenda item is scheduling of future economic forum meetings.
We're scheduled for December 5th. Madam Chair, I think probably looking at this, the 9:30 start time and that flight probably seems to work. Madam Chair, what we may have to just talk with you about, but with the four members sitting here, is you can see it is getting close to 3, and that's sort of what we thought we needed to do to be able to have the members who flew up get on their return flight. We may have to consider the next flight after the 4:45 flight, because as the 3 returning members know, at the December 5th meeting, you're going to actually make decisions, and then fiscal has to go back and get all those numbers into the tables. And then there'll also be a report that goes to the governor and the legislature. And so fiscal's working on that, and a draft of that will be sent out to the members in advance of the meeting so that you can have a chance to review it. And then the numbers also go into that report. And I know we always tell you 45 minutes, but it seems like it ends up being closer to an hour and a half. So not too good at this forecasting stuff, I guess. So thus, we're going to need that extra time, I think, to just not cut us tight for the December 5th meeting. And so that's all I had to say on this agenda item. We will work with Chair Rosenthal after the meeting here to get that, but I think the 9:30 start didn't work too bad. And again, we can set the meeting for 9:30, and we can start late. We just can't start earlier. But let's hope for the flight is on time on December 5th as it was. And that's it, Madam Chair. I'll just work with you as staff.
Great, thank you. So the last agenda item then, again, is public comment. So we'll start here in Carson City. If there's anybody who'd like to make a public comment. Okay, not seeing any. How about down in Las Vegas? Again, nobody rushing to the mic. So then finally, we will ask the BPS staff if anyone is called in that would like to provide public comment.
Chair, the public line is open and working, and there are no callers.
Terrific, thank you. With that, I think that brings to a conclusion this meeting of the Economic Forum, and we are adjourned.